Well, good afternoon, everyone, and welcome, everyone. I am Stephen Taylor. I'm the Commissioner for the Department of Insurance, Securities, and Banking, and I would like to call this hearing to order at 5:03 p.m. today, Thursday, August 17th, 2017, here in the former council chambers at 1 Judiciary Square in the District of Columbia. Please make sure that all cell phones and other electronic devices are turned off or either set to vibrate. I would now like to take a little time to set the stage for this hearing by describing our agency, the purpose of this hearing, and the health insurance rate review process. So first, a little bit about the department. The department regulates insurance, securities, banking, and other financial services in the District of Columbia. Our mission is twofold. First, to protect consumers through our regulation of the financial services industries, and second, to develop and improve market conditions to attract and retain financial services firms in the district. We accomplish this by working to ensure that district residents have access to a wide choice of financial services and are treated fairly by service providers. The department also provides a positive business climate that encourages fair and open competition and supports economic development and business growth in the district. I am joined here on the dais by members of my team: Philip Barlow to my left, Associate Commissioner for Insurance, Howard Liebers to my right, the healthcare policy analyst, and Adam Levi also to my right, Assistant General Counsel. I will later be joined by one of our actuarial consultants, David Dillon from Lewis and Ellis. A little bit about the purpose of this meeting. The purpose of this public hearing is to discuss the 2018 proposed health insurance rates filed by carriers offering health benefit plans in the individual and small market group. And small business, again, is those with 1 to 50 employees. And the intent is to inform the public of the department's process for reviewing and approving health insurance rates and to receive public comments regarding the proposed rates. A summary of the filed proposed 2018 rates and the rate review process can be found on the department's website at dsib.dc.gov. A current snapshot of the revised current rates have been provided to you in the lobby and will also be available online. We will have 2 opportunities for comments at this hearing. First, in a couple of minutes, there will be time devoted to the District of Columbia Health Benefit Exchange Authority, which certifies qualified health plans offered for sale in the District of Columbia. Second, there will be a period of public comment for anyone who wishes to make comments, including district residents who purchase coverage for themselves and their families, as well as small employers who make coverage available to their employees. We will hear first from those individuals who have signed up prior to the hearing. We will alternate between those persons who are present in the room who also wish to comment, as well as we have a teleconference going as well. We'll alternate between the teleconference participants as well as participants in the room here. A little background on the Patient Protection and Affordable Care Act, often referred to as the Affordable Care Act or the ACA, or as you hear a lot on TV, Obamacare. It is a comprehensive health care reform law enacted on March 23, 2010, that generally makes affordable health insurance available to more Americans. Subsequent to the enactment of the ACA, the district also passed a number of laws to implement and enforce the ACA. The district enacted the Reasonable Health Insurance Rate Making and Reform Amendment Act of 2010, which established rate-making principles and standards as additional guidance in reviewing and approving health insurance rate filings. Specifically, the law directs me as commissioner to ensure that health insurance rates and fees are not excessive, inadequate, or unfairly discriminatory. A later law, the Federal Health Reform Implementation Omnibus Amendment Act of 2014, codified provisions of the ACA and is implementing regulations in district law. Let me give a little description of the DC market and the Health Benefit Exchange Authority. The district passed the Health Benefit Exchange Authority Establishment Act of 2011, which established the District of Columbia Health Benefit Exchange Authority. While the department regulates health insurers and reviews and approves health insurance rates and form filings for comprehensive medical products sold in the district, the authority certifies qualified health plans, or QHPs, for sale through the district's state-based exchange marketplace known as DC HealthLink, which is also administered by the authority. The authority also works with us to provide input during our review process. I will let the authority talk more about its responsibilities when it testifies later. The ACA's major provisions were implemented in 2014. Since then, the district has been a leader in expanding access to affordable health care for our residents and small businesses. Because we leverage the ACA, more than 96% of district residents now have health coverage. And we rank among the top 3 states with the lowest uninsured rates in the country. Currently, there are approximately 22,000 people with private health insurance through the individual market, and more than 4,500 employers offering coverage to nearly 64,000 employees and their families through the small business marketplace known as the SHOP. A little description about the rate review process. The department implements what is known as an effective rate review program. Prior to the ACA, annual premium increases in the individual market were highly variable, and increases often averaged 10% or more at the state level. The ACA's rate review program, coupled with several critical consumer protections, has brought new levels of scrutiny and transparency to the health insurance rates in the individual and small group markets. Thus, consumers can view rate information that was not previously available to them. Also, the increased review has resulted in some insurers lowering their rates. States with an effective rate review program review proposed rate increases to determine whether they are reasonable, considering several factors set out in the Code of Federal Regulations. The process in the district starts when the insurance company submits a rate filing request to the department. And again, all rate filings and associated documents are posted on disb.dc.gov for public comment and viewing. The rate review is then assigned to a staff member within the Insurance Bureau's Health Insurance Actuarial Division for review. Due to the significance and time pressures to approve the ACA rates, we also utilize an actuarial consulting firm to conduct an additional review of the rates and make recommendations to the division. These employees and consultants are subject matter experts in mathematics and the measurement and management of risk and uncertainty. They review rates based on a variety of rating factors and assumptions such as loss experience and inflation, with the goal of ensuring that health plan rates are justified and adequate considering the benefits provided. Reasonable rates should be adequate to cover the costs of paying expected medical claims and operating expenses. The division will discuss the rate filings with insurers and, as appropriate, recommend changes. Once the Health Actuarial Division determines that the rate request is justified, the division makes an approval recommendation to the commissioner. Conversely, if the division believes a rate is excessive, inadequate, or unfairly discriminatory, it will discuss its findings with the insurer and recommend changes to the file rates in order for the department to approve them. The department expects to finalize the 2018 rates by the end of this month and post those final rates to disib.dc.gov. Let me give you a quick overview of the current filings. We had 4 major insurance companies: Aetna, CareFirst Blue Cross Blue Shield, Kaiser Permanente, and United Healthcare proposed rates. The companies themselves provided offerings for both individuals, families, and small businesses on DC HealthLink. Overall, 184 plans were filed. That's compared to 171 last year. The small group plans increased from 151 plans to 58 plans, and individual plans increased from 20 to 26. The initial rates filed for the 2018 health plans proposed rates increases for 2017 for both the individual and the small groups. In the individual market, CareFirst proposed an average increase of 39.6% for HMO, that's Health Maintenance Organization plans, and 19.7% for PPO plans, Preferred Provider plans. Kaiser proposed an average increase of 13%. In the small group market, Aetna proposed an average increase of 9.38% for HMO plans and 7.38% for PPO plans. CareFirst proposed 9.5% for HMO plans and 13.3% for PPO plans. Kaiser proposed 5%, and United Healthcare proposed 9.5% for both HMO and PPO plans. This is the end of my introductory remarks. I would now like to ask representatives from Lewis and Ellis, the department's consulting actuaries, to provide a description of the 2018 rate review process and explanation of the drivers for the 2018 proposed rate changes. Mr. Untitled, please join us. Thank you.
Thank you for having me.
Thank you.
I'm going to start with a little description. Just for the record, I guess my name is Dave Dillon. I'm Vice President and Principal in the Dallas office of Lewis and Ellis. In the Dallas office, we have 13 health actuaries that focus on rate reviews and healthcare reform issues. Specifically for the district, we have assigned 4 of those credentialed actuaries to be the lead reviewers for each of the 4 companies that have filed rates here in the district. And additionally, each of those lead reviewers also serve as peer reviewers for some of the other filings so that they see all of the issues that have been filed by all the companies and make sure that all the assumptions, all the issues are addressed by all of the companies. And then in my role, I serve as kind of an overall peer reviewer to make sure that all the market-wide assumptions are appropriately addressed in the filings. So that's kind of our basic setup. The filings were submitted the first day of May. Took about 2 weeks. We made our initial review. We then submitted via SURF, the NAIC system, for the filings, our objection letters. Roughly speaking, we give about a week for responses for those questions from the carriers. We then assess those responses. We determine if we need to ask further questions. I think at this time, between questions asked by my team and by the actuarial team used for the exchange, there have been 14 objections, letters sent out, so 14 different correspondence that we have reviewed to try to assess whether, to your comment earlier, rather, to determine if the rates are excessive, adequate, unfairly discriminatory, and so forth. So that's kind of the general setup. But once we start the review, there are obviously several key issues that we focus on in the review. When we get the filing, we knew for this year there's 2 obvious things, 2 obvious issues that we focus on first because we knew they were, going to be across all filings. One is claims cost trend, which is just the inflationary nature of medical expenses. So that is, there every year. So that is, one of the key assumptions in a filing and one of the key ingredients of a rate increase. One of the other main issues this year was the reinstatement of the health insurer fee, which is a fee as part of the Affordable Care Act. There was a moratorium in 2017. But it was reinstated this year. So we knew going in that was also going to be a key issue with the rate increases. So trend usually runs between 3.5% to 10%, depending on the company. The health insurer fee is typically 2 to 3.5%, depending on the company. So right from the get-go, we kind of know there's roughly 7.5%, 10% of the rate increase that we see that's submitted by the carriers just attributable to those 2 factors. So those are very obvious ones that we start on. Obviously, the submitted rates were in excess. Most of them were in excess of 10%, especially in the individual market. So there were other factors that we did look at. Some of those other factors are things such as, reassessment of the company's prior experience. So when a company sets the 2018 rates, it's based on the experience in 2016. So when they originally developed rates for 2016, let's speak in round numbers. Let's say they thought it was going to be $100, turned out to be $105. Now that they now know it's $105. So for their 2018 rates, they've got to adjust the rates about 5% more because the 16 experience was a little bit worse. We look at the administration costs, if they are increasing. Risk adjustment is obviously also a very key factor in looking at rate increases. Risk adjustment is a market-wide assumption that carriers have to do their best to guess not only how risk adjustment will affect their own company, they have to kind of measure and assess how it'll affect other companies. And that was a very key issue for the carriers. Other things they have to look at that we analyze are changes in demographics. As I said, the rates are based on 2016, but there is early hints of 2017 experience. So the companies will look at if the populations are getting younger, getting older, getting sicker, getting healthier. So those adjustments are also built into the 2018. Benefit changes, if there's any changes to the standard plans, those will also flow through. If they're covering more benefits, they have to charge more accordingly. And then, a key one is the contribution to reserve or risk margin, the margin for uncertainty. And as you'll see, the companies have taken different approaches. As everyone in this room knows, there's a lot of uncertainty going on in the health insurance market, and so that provision is also analyzed to see how it would impact the rate increase from each of the carriers. So those are the key components that we review. So there was one of the handouts kind of describes the initial filed rate requests and the revised rate request. So I will briefly touch on some of the issues that got us from where we were to where we are now. On the United companies, there was one reduction, and that was due to their trend assumption. We did not believe that it was adequately supported to go from the prior assumption to the new assumption. We discussed that with the company, and the company has revised their rates to include the prior assumption for trend. On the Aetna filing, there are no currently suggested modifications. There were what I would say some ups, downs, and sideways, but in the aggregate, we felt that the rates were appropriate, so there were no modifications there. On the Kaiser filing, similar to the Aetna filings, there were a few things that did catch our eye, but in the aggregate, we have made no recommendations, and the company has not made any modifications, primarily due to their assumption of a lower rate as a result of a contribution to reserve that is negative. And so as a result of that assumption by the company, we did not feel it was appropriate to make any modifications to any of the other assumptions. In the Care First filings, I will try to speak in generalities. As you said, there are two companies and an individual and small group for both of those. So some of these adjustments that I'm about to comment on do affect those products and those companies differently. But in general, there have been 7 modifications from the original filed rates to the current filed rates. Most of them, of the initial ones, were relatively small in nature. Those included modifications to the risk adjustment program. The federal level risk adjustment formula has changed for 2018, and there were multiple changes there. And it was determined that one of those changes was not accounted for in the rates. So that rate change was implemented, and that had offsetting that decreased the Care First HMO rates that increased the PPO rates. There was a minor error in the health insurance fee calculation that was adjusted. Commissions, the company publicly stated that they would not be paying commissions on the individual business. The commission load was in the original filed rates, and so those have been removed to compensate that they will not be paid moving forward. There was a modification to the small group rates on Care First. Regarding the MLR, as you are aware, the minimum loss ratio is set so, the company has a certain amount of the premium set aside to pay for benefits, and in the original calculation, it didn't meet that requirement, and so a reduction in the rates was made to compensate for the MLR requirements. And then additionally, in the last 2 modifications, one was the removal of a HSA adjustment for the plans that an HSA or an HRA applied to. We did not believe that their adjustment factor was supported, and we discussed that with the company, and they agreed to remove that factor. And then the last adjustment is, as you can see in this table, that the revised rates are now equal between the two companies. One of the interesting dynamics in the DC market was because of its structure with the merged market and things, what happens was the initial rates, the HMO rates, were higher than the PPO rates, which is a little atypical. HMO, generally speaking, has a limited, narrow provider network, and because of the limited choice in most markets, HMO products are cheaper than the PPO products. However, in this market, there were kind of some distortions, and as a result, that was why the Care First rates, the HMO rates, were higher. And the company, after discussing this issue with the company, they have revised their rate request to kind of levelize those differences so that the HMO rates, instead of being approximately 6% higher than the PPO rates, they are now, I believe, around 7% lower than the PPO rate. So, and just as a reference point, in most markets, I would say that the HMO rates are, 25 to 35% lower than PPO rates. But at least this levelization, proposed levelization of the request would at least directionally bring those rates between HMO and PPO relativities in line. And I believe that this kind of summarizes everything I wanted to discuss.
Thank you very much, Mr. Dillon. You had mentioned that you thought there might be an impact on the rates with the fact that we merged the risk groups in the market. We don't actually merge the two markets. We still have a separate individual small group market, but we actually do merge the risk pool. I think there might be 2 other states that actually merged the market. What implications do you think the merged market would have on the rate increase that actually impacts the rate increase, merging the
Yeah, so DC, there aren't very many states that do merge markets. Massachusetts is one, Vermont is one, and DC, and DC has, I would kind of say, as a partially merged market. And the reason the states that have gone to merged markets, the reason they do it is to stabilize the individual rates. Okay, so you basically combine the small group and the individual market so that the small group market, which is typically a larger market, would help subsidize and kind of stabilize the rates in the individual market. Based on information we were provided in this rate review season, there is no question that has occurred in DC. Our estimate is that, like, for example, the Care First rates would be 15% even higher if the merged market was not in place. However, the way DC has applied the merged market has created a few distortions that has impacted the rate increases that you see this year. And it's kind of a difficult actuarial formula, so I'll try to explain it rather simply. But in DC, the claims costs that are used to develop the premium, so the medical expenses, are merged. Okay, so that small group and individual claims costs are combined for premium rate development. And the small group market is approximately 3 times bigger than the individual market. Okay, the problem is, or what causes some of the distortions in DC, is the risk adjustment formula is not merged in DC. So let me try to give you a simple example of the distortion is, so I mentioned that the small group market is approximately 3 times larger than the individual market. So let's say we have, there's 4 of you sitting up there, so this is perfect. So let's say you have 3 people and you guys are $100 a piece, okay? Your cost is $100. We'll say Philip, Mr. Barlow represents the individual market, and he's $100 a piece. So we have $400 between the 4 of you. Well, what happens is, so we combine those, the carriers combine those for the premium rate development. Well, let's say Mr. Barlow gets healthier, okay? So instead of $100 cost, he only costs $95, okay? Well, so that's a $5 reduction out of the $400, so it's $395, about 1.5 points cheaper, okay? Well, the risk adjustment formula is based only on the individual market, not the merged market. So if Mr. Barlow gets healthier, the risk adjustment formula, we talked about he got healthier by about $5. Well, that 5% increase now has to be applied to the individual market. So even though his improvement only impacted roughly 1.5% on the claims cost side, and the small group stabilized that, right? It made it much smaller than his true impact, but the risk adjustment formula is only based on the individual market separately and the small group market separately. And so you can see that in the Care First filing, for example, they had a lot more healthier people in the individual market than originally anticipated. Because of the merged market, they had to pay quite a bit more risk adjustment, and that is a big piece of the rate increase.
Thank you. Next question. You had talked about some uncertainty earlier, and that a number of carriers had made some adjustments and assumptions based on the uncertainty. Is there a way you can sort of give an overall thought on what you think the impact of that uncertainty is on the overall rates in the district?
So
I should say that the overall increase in the
yeah,
rates
so the uncertainty is obviously, very tricky. As an actuary, we like to quantify everything, and when we read the papers and we hear about all the, possible non-enforcement of the individual mandates, or we hear about the non-payment of cost-sharing reductions and things like that, those are very difficult to quantify. What we typically do like to see as we review a rate filing is we do like to see that each of the underlying assumptions are best estimates for that given assumption. So I mentioned demographic assumption. We don't like those to be conservative. We'd like those to be best estimates. If a product is getting worse, let's say it's 5% worse, we'd like to see that the company's adding a 5% load because of that worsening. We don't want to see, conservative values. That's what that contribution to reserve or the risk margin is for. And as I mentioned at the beginning, there are different levels of assumed margin. Kaiser has made the assumption that they've made a business decision that even in light of all the uncertainty in the market, they are proposing a negative margin. They're trying to keep rates low. So that is their way of addressing the uncertainty, is not necessarily applying any margin for the uncertainty in the market. We typically see uncertainty margins between 0 and 5%, and the carriers here have fallen in that range. So typically, even though this year's uncertainty may be higher than the last couple years, we have not necessarily seen that reflected in the assumptions here.
Great, thank you. Last question I have is, what are your expectations in terms of the level of increase that we can expect in 2019?
So obviously that crystal ball is a little cloudy. But I will say, so, what these rate increases that we're talking about tonight, I would say are, kind of the tightening of the lug nuts, fixing the transmission. As I said, there's been a lot of uncertainty the last couple years, and some of the assumptions have proven to be incorrect. And so they're truing those up, and the carriers believe those are, that they are good for 2018, so they're truing those up. But as we just alluded to, there is a lot of uncertainty for moving forward. And, so when they've made these estimates for 18, like things like risk adjustment, as I said earlier, not only do they have to make assumptions about the people they are losing or they are gaining and how many they're getting and how sick those people are or how healthy they are, they really also have to make estimates on how healthy and how many people, let's say Care First has to estimate how many people they think Kaiser is going to get, how healthy those people are going to be, to get a good estimate of risk adjustment, which is such a key thing. So, that is a provision that I think is highly uncertain for 2019. One key thing will be that the health insurance fee, as of right now, will still be around. And since that will impact the rates this year, there should be approximately, the rate increases for 2019 would be approximately 3% less, all other things being equal to this year, because the health insurance fee will still be there and it won't be a new cost. One obvious consideration for 2019 would be the business decisions currently made by Kaiser. They're currently making the decision to have a negative margin. which can be considered non-traditional for various reasons. And so if they change that business decision and let's say just try to break even, that could significantly impact, their rates, which, is one of the two carriers in the market.
I did say that was the last question, but I think I may have another one or maybe two. And I just forgot the one I was going to ask. Darn it. Yeah. Hold 1 second.
Sure.
I guess the sort of one question, when you look at the Care First rates, I guess those are the largest increases. And again, when I say rates proposed increases, 24%. So if there's some individuals in the room who are going to who have Care First now in the individual market, and they're looking at 24% increase, what would I tell them, sort of in more layman's speak, why their rates are going up?
So,
what's the sort of biggest impact?
Yeah, to kind of tie it back to some of the assumptions that I mentioned earlier, some of the key issues we review is, let's say of that 24%, approximately 5 to 7.5% is for the inflationary piece that every carrier has. And so that is no different for Care First than any other, carrier in the marketplace. And again, the health insurer fee is 3% of that increase. That is in reality a provision that Care First can't do anything about. It's a reinstatement of a federal level fee. So, approximately 10% are for those two key issues. And then the other issues are, again, I would say it is related to the uncertainty of carriers assessing, the relative health status of the people they get and how many people that they get. Obviously, with the implementation of the Affordable Care Act over the last 3 or 4 years, there's been a lot of movement between carriers. There's been a lot of uncertainty, and carriers are just now starting to get a better understanding of what their populations look at. And so I do believe that, quite a bit of that of this rate increase is due to Care First getting a better understanding of their population. And as I mentioned earlier, the risk adjustment is a very big piece of the rate increase, and that was them, again, having shifts in membership over the last couple of years, getting healthier, and because risk adjustment is a market-wide assumption, just because they are healthier, they do not get to keep that windfall of having healthier people. They have to kind of redistribute that money to the carriers that maybe coincidentally got sicker populations. And so those carriers that had sicker populations, they don't have to, take on that full brunt of the losses. Because of the guarantee issue, a carrier has to accept whoever comes into the door and wants their coverage. So when Care First has that healthier population, they don't get to keep that money. They have to kind of pay a portion of that back to the market, and that is a big piece of this rate increase.
And my understanding is that's required by federal law. That's
correct.
Part of the ACA that requires them to pay the other carriers.
Yes, the risk adjustment is a permanent feature, or I should say it may be a currently permanent. Things can change, but that is a permanent feature of the ACA that does kind of redistribute funds from between carriers depending on the health status that the carrier coincidentally attracts.
All right, well, thanks very much, Mr. Dillon. Really appreciate your work on helping us and really kind of explaining here for the public, and look forward to you joining us up on the dais when you have a chance.
Thank you.
Thanks again very much. And this time, I will invite Ms. Mila Kaufman, the Executive Director of the District of Columbia Health Benefit Exchange Authority, to testify.
Thank you, Commissioner. My name is Mila Kaufman, and I'm the Executive Director of the DC Health Benefit Exchange Authority. And I would just like to introduce Tammy from Oliver Wyman, and she's here to answer any actuarial questions you may have, since I do not like to play actuary, as you know.
And Tammy has a last name too, just in case?
you want to introduce yourself?
I'm Tammy Tomchuk.
Excellent, thank you for joining us. Ms.
Thank-
Kaufman, when you're ready, thank you.
Thank you, Commissioner. Oh, there we go. And I believe that there are paper copies of the PowerPoint slides available to folks who are here in case you cannot see the screen on the side of the room. We appreciate Commissioner Taylor's support for the Health Benefit Exchange Authority's efforts and consideration of our recommendations. DC HealthLink is the online health insurance marketplace for small businesses and residents here in DC, established to get people covered and provide transparency, encourage market competition, and simplify the purchase of insurance, providing residents and small businesses the type of market power only large employers had in the past. HBX is a private-public partnership with a private executive board of DC residents. Although we were the last state to start building the IT system, we were one of 4 states that opened for business on time on October 1st, 2013, and stayed open. We fight for all of our customers to ensure broad product choices and best possible premiums. And I'll just brag about some of our most recent recognitions that we've received. Amazon Web Services recognized DC HealthLink for best practices in innovation last June of 2016, and that was for our open source code, agile development, and in the cloud IT system. We were also ranked #1 among all state-based marketplaces and the federal marketplace for consumer shopping tools by Clear Choices. And we and Massachusetts are the first in the nation state-based marketplace partnership. We were selected by the Massachusetts Health Connector to provide IT shop solutions and ongoing support, replacing their former shop with DC HealthLink technology. Our role in rate review is to advocate for the lowest possible rates for our small business and individual customers. We provide the insurance department with actuarial basis and policy reasons for the lowest possible rates. Every year, we hire actuaries, Oliver Wyman, to analyze proposed rate filings, to identify unsupported assumptions and mistakes, and work with the insurance department actuaries collaboratively to address those. And I would just like to add, just like your external actuaries, Oliver Wyman has assigned 4 lead actuaries, 1 to each carrier's filings, and they also do the same type of peer review as your external actuaries. I think that is the best practices standard in the industry. In terms of our recommendations for your consideration, and I'll start with what we're recommending for small group rates. And I'll walk you through by carrier. So starting with Care First, their initial filed rate is an average of 9.5% increase. They've refiled their rate, I believe yesterday, proposing a 7.2% increase as an average. Based on the actuarial analysis performed by Oliver Wyman Actuaries for us, we recommend a 5.3% increase. GHMSI is the PPO side of Care First, and they initially proposed a 15.3% rate increase. They refiled with a 15.5% increase. We believe a 13.9% average increase is actuarially supported. Kaiser, and I'll group these together, Kaiser, Aetna Health, and Aetna Life, we believe that their initially filed rate requests are actuarially supported. United's three companies, United Health Optum, United Health Insurance Company, and United Health Mid-Atlantic, initially filed 9.5% average increase. Their refiled filing indicates a 5.6% rate increase. We recommend for your consideration a 4.6% rate increase. Okay. For the individual market for 2018 rates, CareFirst initially filed 39.6% rate increase. Yesterday, they refiled a lower proposed increase of 24.1%. We've had a little bit of time to analyze the rate filing, but we will continue to look at it more carefully since we've only had less than a day to look at it. Based on the initial analysis, what is actuarially supported is 22.6% blended rate increase. And I'll note that based on the work of Oliver Wyman's actuaries led by Tammy here, and your external actuaries, it appears that CareFirst had agreed to the feedback that the actuaries provided on initially having incorrect or unsupported assumptions. And I think the only area of disagreement there is what the trend looks like, but all other elements were pretty much agreed to by the actuaries involved. As a policy matter, HBX has a different recommendation, although we recognize that actuarially supported rate increase is higher. We think you should consider, for public policy reasons, which I'll get into in a minute, a much lower, substantially lower increase for CareFirst HMO. We think, for example, you should deny about a third of the actuarially supported increase and allow 16.4% average increase. And if you deny a third of the actuarially supported increase, that is approximately $4 million less CareFirst HMO would be collecting in premiums. Of course, to consumers, to DC residents, it's huge. And you should also consider a phase-in for any rate increase that you approve to mitigate some of the public policy concerns that I'll get into, and certainly the impact of any rate increase on DC residents. GHMSI, which is the PPO side of CareFirst, initially filed a 19.7% increase. Yesterday, they refiled for a 24.1% increase. And based on our initial actuarial review by Oliver Wyman Actuaries, the actuarially supported rate increase is 22.6%. That's the blended rate increase. Again, our recommendation to you, based on policy considerations, is for you to approve a substantially lower increase than the 22.6% that we believe is actuarially justified from the actuarial review. Finally, Kaiser, initial rate filing is 13% average increase. We believe that is actuarially supported, and we support approving that. So we urge you to deny the CareFirst proposed rate increase, and as I've mentioned, 22.6% is actuarially justified, but 22.6% is unjustifiable as public policy. We're very concerned about the large rate increases that threaten market stability. and impact DC residents in a negative way. DC residents will no longer be able to afford their premiums. DC residents may become uninsured. Healthy people are more likely to drop coverage than sick people. Sicker pool means higher prices for everyone. Sicker risk pool means instability. These are the major public policy reasons we urge you to consider when making your decision on whether or not to approve the proposed increase. Kaiser is a great example in this case where public policy does win the day over actuarially justified rates. Kaiser could have asked for an actuarially justified rate increase as much as 2 times higher than their requested rate increase. Kaiser chose not to do that based on the company's concern about people becoming uninsured. Kaiser said they wanted to make the 2018 rates more affordable. Some may wonder whether approving a lower than actuarially sound or actuarially supported rate increase will jeopardize the financial condition of an insurer. So this slide on risk-based capital, which is how insurance regulators determine the financial condition and the health of a company financially. As you can see, both CareFirst HMO and the PPO side of the company are financially solid, and certainly approving a lower, substantially lower increase for next year would not jeopardize their solid financial condition. Again, we urge you to approve a substantially lower rate increase, and you should consider phasing in any increase to mitigate the risk of significant coverage drops for DC residents losing their health insurance. So denying 1/3 of the increase and allowing a 16.4 average increase is what we're suggesting to you. And again, denying 1/3 would mean $4 million less in premiums collected by CareFirst HMO, but huge difference to DC residents. And I'll just spend the next minute providing you with some general information that I think is important and goes to some of the questions you asked earlier. The ACA and rate review has been tremendous. The ACA has had a significant impact for states in their ability to really scrutinize rates. Before the ACA, state insurance regulators' authority varied dramatically, and in some states there was no authority to look at rates. And you mentioned in your opening statement, Commissioner Taylor, that here in DC in 2010 the law was changed to empower you to scrutinize rates to ensure that DC's residents who purchase health insurance are protected. The ACA has made a tremendous difference everywhere on that front. And initially, the ACA had significant and important stabilization elements, which unfortunately, some of which unfortunately had been changed from the original intent. And all of these rate stabilization elements helped to keep prices lower than they otherwise would have been. One example is risk corridors, and I'm not going to get into the weeds on that. I'll just say the insurance companies are still owed by the federal government $8.3 billion, billion with a B, for 2014 and 2015 for risk corridor payments. There's a lot of litigation around that, but it's worth noting that restoring the original intent of the risk corridors program would have a positive impact on private health insurance. The reinsurance program that the ACA had was temporary, and it should be extended and made permanent. Just to recollect your memory, in DC, federally funded, no local dollars, all federal dollars for reinsurance made a huge difference in lowering health insurance rates here in the district, as you can see from the slide. So in terms of public policy generally, we need the federal government, Congress, to enact bipartisan solutions, especially focusing on federal dollars for reinsurance to help drive premiums down. You heard earlier that the health insurance fee is back and is being passed on to consumers. That fee is a problem and needs to be addressed. As you know, the Health Benefit Exchange Authority has an ACA working group, and the working group will be considering recommendations on locally funded reinsurance to help address future rate increases. We'll also be looking at other local policy interventions that will result in keeping health insurance more affordable and our robust and stable market stable. In conclusion, I would just like to, again, thank you for holding this hearing, the first for DC in all its years. Very much appreciate your leadership in taking the step forward. We appreciate your willingness to consider our recommendations for the lowest possible rates for DC residents and small businesses. And we are submitting to you an analysis supporting the actuarial recommendations. Thank you, and I'm happy to answer any questions you may have.
Thank you, Madam Executive Director. Really appreciate your testimony, and I'm really glad that you did do all that bragging in the beginning, and that you should have. I think you have a wonderful team, and I'm lucky I actually serve on the board of the authority, but you have an excellent team, and I think the partnership with Massachusetts speaks volumes of your leadership and what the authority has actually done. So really appreciate all the work there, and glad to be part of the board as well and to work with your team. Also, thanks very much for your presentation. And I think it really kind of helps, again, explain to consumers sort of health insurance in the District of Columbia. So it's very helpful, and I do really appreciate your thoughtful recommendations on how to sort of address some of the proposed rate increases. And with that, I'm going to just kind of pivot a little bit back, go back to some of the recommendations on starting back with the small market, the small group market. And I think with the Care First and GSMSI, I think there's a recommendation to lower the proposed increase. And I know that you mentioned on the individual market, you thought some of the differences on the Care First HMO was trend, and was wondering what the differences on the small group was for the Care First and GSMSI delta there.
Tammy?
Sure, as Mr. Dillon, mine's not on. As Mr. Dillon explained later, there was a series of questions that went back and forth and a series of factors that were adjusted. But based on the most recent filing, at least the one as of 2 days ago and the one we saw this morning, the remaining difference on both the individual and small group Care First GHMSI filings is simply trend, a difference of opinion on the trend assumption.
Great, thank you. What about the differences on the United plans?
I knew you were going to ask that, and I didn't review the United filing, so I'm going from memory here. There were 3 components, each worth about 0.3% that add up to the 1% difference. I believe one was due to the non-EHB covered benefits and the way they were calculated and implemented. One, you have it. One was due to the age calibration methodology that was used, and the third was due to risk adjustment.
Great, thank you. And So going on to the individual market analysis, on GSM's side, the PPO, you had recommended substantially less. And then I was looking in the box to see if there was a number there, but I didn't see a number there. Did you have a recommendation what the actual number should be? I guess they had refiled 24.1, you have 22.6, but then you're, I guess, making the policy recommendation for something substantially less, and I'm wondering what that amount would be.
We do not have a specific recommendation. We thought by providing you with an illustrative example for the HMO side and providing you with public policy concerns and justifications, that you would consider those in what the substantially lower rate you ultimately approve.
So basically kind of following the model for the HMO, basically, sort of taking, denying a piece of it and then phasing in the remainder. Is that what you're thinking on the PPO?
Correct. We are recommending phase-in approach. Last year, the rate increases were substantial, as I know you remember, and year after year, substantial rate increases do force, especially healthier people, to drop out. So we're very concerned about the impact of multiple years in a row of significant impact. A phase-in is what we're recommending, and like I said, we are not recommending a specific amount of for an approved rate increase for the PPO side. We just believe it should be substantially lower than the 22.6% we think is actuarially supported.
Great, thank you. And I really, again, appreciate the recommendation and understand the policy concern, and we too are concerned, again, about market stability and making sure that the insurance is affordable as well. No point to have insurance if people can't afford to pay the premiums. I guess one question that might sort of come up is why would we phase in for the increase for Care First but not the other carriers? And is there a policy argument I would say, okay, well, we'll do it for the Care First products but not the other products that have some significant increase, and not as high as Care First, but still some significant.
On the individual side, the only other carrier is Kaiser, and they're asking for an average of 13%. If you approve that, we're not recommending, or if you approve a 13% hypothetically for Care First, HMO, or PPO, at that level, the phase-in may not be necessary, but at higher increase levels, the concern again is healthier lives leaving the pool.
And I guess with a Kaiser, I guess, going back to your testimony, that you had thought that they could have actually asked for something larger, so in theory they kind of did some kind of policy decision themselves. That's what you're thinking?
That's correct.
Okay, thank you. And there was some talk, there's a lot of talk on the Hill. One thing they sort of talk about is not paying continuing to reimburse. They sort of talk about it as a bailout, but it's actually a reimbursement of insurers who have provided insurance policies with cost-sharing reductions in there, looking for reimbursement from the government. What impact do you think it would have on the rates if they did stop the CSR for 2018?
Mm-hmm. So we are different than most states. I guess we're similar with a few states like Minnesota and a few others, where the population is relatively low that benefits from cost-sharing reductions. In DC, we have about 280 people. So it's a very small population, and the impact of cost-sharing reductions in a rate is not even a rounding error. It's so small. However, with that said, it is important, it is critical for the federal government, for the Trump administration, or congressional leaders to address the cost-sharing reduction issue nationwide. I think there are about $8 billion owed to insurance companies to reimburse them for cost-sharing reductions. And I appreciate what you said, that it's not a bailout. Cost-sharing reductions enable people who qualify to not have to meet their deductibles before they can see a doctor. It's very important for lower and middle-income people who qualify. And so without those, you've seen around the nation huge market disruptions, some markets at near collapse because insurers can't stay in business if they're paying cost-sharing reductions but are not getting reimbursed for those from the federal government. It's led to the Bexar County's problem, where in some states and some counties, you don't have insurance companies anymore. It is this instability and the unknown whether or not the Trump administration is going to actively enforce the individual responsibility requirement that's led to a lot of instability around the nation. Some states have been able to shield ourselves from that, including here, but it is very important locally for us to see what interventions we can take to further stabilize our market, and critical for the Trump administration to make a commitment to reimburse cost-sharing reductions nationwide.
I appreciate that very much. Any other thoughts of how uncertainty in the market, and again, the whole conversation about repair, replace, and I hopefully just repair, and they sort of enhance it, but what is the uncertainty you think doing to the rates overall and the markets overall?
So in some states, huge havoc. In some states, the impact of cost-sharing reductions and the uncertainty has forced insurance companies to file two sets of rates, essentially, one with certainty and one without. Here, because our population relying on cost-sharing reductions is so low, 280 people approximately, we are in some ways shielded from that huge instability. I also want to say, I want to applaud your efforts and your engagement, especially through the National Association of Insurance Commissioners. You've been one of the leaders in that discourse, and the letters that the NAIC has sent around the market stability issues have been very helpful.
Well, thank you for that, and thank you also for your letters as well in support of those, in support of our efforts around the country and towards Congress. One thing I'd like to sort of ask, what do you, what role, and maybe this might be a question for your actuary, what role do you think market share plays in developing carrier rates here in the district?
Sure, I understand the question.
So what role, so if you have a dominant carrier in the market and they have a large market share, what role do you think that market share, the dominance, plays in pricing?
So I think it's a policy question.
Policy?
Yeah.
About that.
What we've observed is there are some people who, love Kaiser and would never do anything but Kaiser. And then there's some people who are Care First people through and through and would not even consider Kaiser even when Kaiser offered better rates. And so when you have a dominant player like Care First, it is very important to make sure that rates are as affordable as they could be, because those Care First people will not switch to Kaiser. And the problem becomes, every year when their rates have increased, they may not be able to make the kinds of sacrifices that it would take financially to continue to pay those premiums. So when you have a dominant player, public policy really is part of your equation, and we urge you to consider it.
Great, thank you. And just to sort of follow up again on the sort of public policy issue, and again, in considering your recommendation to phase in, are you aware of any other jurisdiction that phases in rate increases? And if there are, what you think what the impact's been, or maybe that's something we can talk later about? If you don't have that information.
Sure, so I can tell you when I was in Maine, wearing my old hat as superintendent of insurance.
And you did a great job as superintendent in Maine, as I understand. So,
Thank you.
yes.
Very, very proud to be in the alum club. So we did have several situations where the dominant carrier, we required them to phase in their rates, and it did not, the dominant carrier there was Anthem, and it had positive impact on consumers being able to afford those rates, and from my perspective, no negative impact on the company, although I'm sure they'll tell you otherwise.
Well, thank you very much. That's all the questions I have. And again, thanks to the DC Health Exchange Authority. Really appreciate that. Oh, I think we may have a question from Mr. Barlow.
Thank you. I think this is a quick question, but I believe that denying part of the rate increase is essentially phasing it in if it's actuarially justified. I assume that's kind of the same thing, unless there's something I'm not getting about that, just to make sure that I understand.
Yeah, so thank you for that clarification, for the opportunity to clarify. In our example, denying really means denying and only approving 16.4% increase, period. So we did not intend for that to mean that you phase in 22.6%. Our intent, our recommendation to you is 16.4% increase. And if you do, if you take another approach, then phasing in whatever you do. And we can get you more details around that as follow-up.
Great. Well, thanks again, Ms. Kaufman and Ms. Tomczyk. Really appreciate your testimony and presentation. Thank you.
Thank you.
And at this point, we're turned to the public witnesses. As I mentioned earlier, we'll take the witnesses who signed up first, and we'll also go ahead and alternate between folks in the room who've signed up after the fact, and we're going to take your comment as well, but also work with the people on the telephone. And for those folks on the telephone who want to provide public comment, please press 0, and then you'll be added to the witness list. So with that, so the phone folks will take care of that, and we'll go ahead and start going through the list of witnesses. And do we have all 3 microphones working there? Okay, so I'll sort of take 3 at a time. So the first one would be Tracy Craig, and Armen Avagan, and Wendy Williamson. I'm sorry if I mess up anybody's name.
Hello.
And we go right, my right to my left, and as soon as you get started, if you please identify yourself, and if you're representing an organization, please feel free to state the organization as well. Thank you.
Yes, my name is Tracy Craig, and I'm a DC resident on DC HealthLink.
If I can interrupt you. So we're trying to give everybody, so everybody has a chance, so I think we're going to limit to 5 minutes, and we have a gentleman over here, so to keep time and put up a sign when it's time.
Time
So-
for myself, I think it's under
Yeah,
5.
so sorry to interrupt you.
okay.
Please go ahead.
I'm speaking today as someone who is self-employed, someone who is soon to be 52 years old, someone who has been healthy for the majority of my life, with 2 short interruptions where I dealt with breast cancer and an ovarian tumor. I'm speaking as someone who has worked steadily my entire adult life, someone who has continually strived to better myself and to be a responsible, contributing member of society. The first thing I'd like to note is that I am incredibly grateful for the ACA and for the insurance providers who continue to participate in the exchanges across the country. DC HealthLink is what allows me to continue to access comprehensive health insurance. It would be an exaggeration to say I'm alive today because of the ACA, but without the diagnosis and treatment I unexpectedly happened to need late last year, my life would be very, very different right now. That said, the proposed increases in premiums next year on the exchange are of great concern to me. I fear that the security I gained through the passage of the ACA, the access to health coverage, will be lost, and that I will be priced out of the market with no other options. The average proposed increase for the 2018 CareFirst PPO plans, which are what I have been enrolled in, are now shown to be 24.1%. I had the 19.1, I worked 0.7, I worked from that. When you review the increases for those in my age bracket, however, they are much higher, with the bronze plan, for instance, showing an increase of 36% from this year's cost. This works out to an additional $1,650 a year, with the deductible that is $1,000 higher. These types of increases are completely untenable. No one can be expected to absorb these types of rising costs. Even for people in the best of circumstances, accommodating rate increases of 15, 20, 30% or more a year is next to impossible. And remember, this is just the cost for premiums to simply have access to coverage and care. If you actually need treatment for anything, you will have to come up with much, much more. I have gone to great lengths to continually retain some type of health insurance over the years. I am someone who purchased an individual plan for myself as a 20-something when my employer did not offer health insurance, who bought a catastrophic plan for a time period in my 30s when no other option was available, who drained my savings in order to stay on COBRA for 18 months to remain insured, pre-ACA, when I was considered uninsurable. In going back over some of my records, I found that the increases in my insurance premiums over the years have averaged about 9% a year, while on DC HealthLink, they've averaged about 6% a year. That is well above any increase in my wages or billing in the years I've been self-employed. It has sometimes been tough to manage, but I've done it. But increases that are 2 or 3 times that? How can anyone be expected to manage those? I am not alone in this challenge. Many others are self-employed or work several part-time jobs or work for small employers who do not offer health insurance. They may be working long hours and make good money and be continually advancing at work or growing their business, but there is no way they can keep up with the premium costs that rise by 20 or 30% or more each year. I have had a great experience with DC HealthLink, and I've had a great experience with CareFirst. I am happy to pay my premiums, and I don't expect a tax credit or a subsidy when my business is going well. I just need those premiums to be reasonable, realistic, somehow manageable and affordable. The proposed rate increases are not. Thank you for your time.
Thank you. Please.
Hi, my name is Armin Avakian. I'm also a DC resident, also on the DC HealthLink. And I hear a lot about the young demographic, the healthy people that might drop out of the marketplace. And I'm here to represent those because I feel a lot of times we just hear about them and don't really see them. So I'm 27 years old. There's on the pamphlets you gave out at the entrance, there's a section for the 27-year-olds with their premiums. And I have been lucky enough to have been healthy for so far. And but I also have been paying my insurance every month to avoid the penalty. Before the ACA, I was uninsured, so there was always that looming danger of having some sort of medical emergency and coming under financial distress. With the ACA, I was glad that there is some sort of help, although the fact that I'm still paying monthly premiums every month, and as mentioned before, the deductibles are so high that it's really only going to be useful in a catastrophic event. It's very hard for me to really keep up with the rate increases. So the increase from 2016 to 2017 was already quite enough, and then from 17 to 18, it will get to a point where I think just financially it'll be easier for me to just take the hit on the penalty at the end of the year rather than pay the monthly insurance. And I think this is what a lot of people have been warning, that the young and healthy people will drop out of the marketplace, increasing the rates for everybody else. And so, as mentioned in the presentation before, I think it is very important as a public policy tool to ensure that the rates stay manageable, just so that the overall risk pool of the insurances can be contained so that the prices don't explode in the long term. Thank you.
Great, thank you.
Good evening. Thank you for hosting this. First time I've heard about this, so I'm very happy to be here. First, I should say that in my early 20s, I didn't have insurance, and I fell and hit my head, and I had to go to the ER. And when you're 22, 23 out of college, you're like, what? Insurance? No, I'm sorry. And my bill was $2,500, and I put it on my credit card. And I learned since then that it's very good to have insurance. When I was fully employed, I had insurance. I was unemployed from 28 to 32, 33. I went back to school. I had a job at the .com bust, but I'd always paid my insurance. I started off paying $143 a month through CareFirst. And I've been one of those CareFirst loyal customers. I don't want to switch to Kaiser or anybody else. My doctors take CareFirst, and I've been living here for over 25 years, and I've had the same doctors. They know me, they know my health, and they know my family background and everything. Before the ACA, I worked for I still work for the same company. We have a small group of individuals. We have 9 people. And we were very fortunate to have a company that provided an HSA or an HRA. We were given $1,000 a month to pay for medical expenses. And so if you're my age, you had about $200 for insurance coverage. In 2005, my insurance was $203 a month. So I had extra money to pay for eyeglasses, dental visits, because there's no dental insurance, and other medical expenses like co-pays, other things that insurance didn't cover. I am fully aware that not everybody has insurance, and I think everybody should have insurance. Because of the ACA, my company could no longer do the HRA, and so I no longer had the $12,000 tax-free available. And so now I am out of pocket, and in 2014, I was out of pocket over $10,000. That includes the $312 a month I paid for insurance. It included a $3,300 deposit I put into a health savings account in order to help me in tax time, but that only covers so much. My out-of-pocket expenses overall were 10 grand, but I also paid an additional $6,400, in total 10,000. I am on track this year to probably pay close to $12,000 to $15,000 out of pocket. $15,000 would be with the increase that they talked about earlier today. The increase of 16.4% that is recommended instead of the 22.6 for the CareFirst Silver plan, or just the generic average. At 22.6, my insurance on average would be $468 a month. That's just me. That's $5,600 a year. That's just insurance. That's not co-pays, that's not things insurance doesn't cover, that's not eyeglasses, that's not dental, that's not anything. And even at 16.4%, my yearly expenses would be $5,300. And that's just insurance. I'm all for everybody having insurance at varying grades, but like other people have mentioned, just even more than 10% is a huge hit. And I believe that, insurance companies do make a profit. Whether it's $10, $20 per person, they do make a profit. And, it's just unfortunate that some people are faced with having to have insurance or make a car payment, or have to pay for their condo dues or pay their rent. And when one person doesn't pay, that affects other people who do pay. And through no fault of anybody else who can't pay, it's a shame. And whatever you as a group can do to dissuade over a 20% increase would be welcomed. anything you can do to dissuade a 15% increase, I think we'd get excited about. But I didn't really prepare many remarks. I just did the numbers. But 10 years ago, I paid $238 a month, and now I paid $382. Thank you.
Thank you all for your testimony. Really appreciate that. And one point you mentioned, Ms. Williamson, is the fact that everybody should have insurance, and even young people as well. And I know a story about somebody who was 28 jogging along the trail by National Airport and actually got bit by a rattlesnake, and that cost $60,000 with the anti-venom and everything else. So again, I'm glad healthy people should be getting insurance as well, and I'm glad you had your coverage as well. So I think all three of you have Care First as your carrier, and just want to know, I guess you would support the phasing in of the increase as recommended by the exchange?
Keeping it to that 16.4, I mean, I will still take a much larger hit at my age. That's still probably going to mean over 20% increase for me, which is going to be a big change from about a 6% increase on average to date. But anything that cuts it down, it's just, I look down the path and I say, how long can I do this? How many of these increases? When do and where do I go after that? Because I'm self-employed and I've been self-employed a long time. So I would appreciate any reduction. Obviously, the more, the better. But
yeah. So again, we're trying to do what we can do. I mean, part of it, I'm sort of guided by the sort of the standards of whether a rate is excessive, adequate, or unfairly discriminatory. So again, we're going to try to get and that's what we kind of do with the actuaries and really studying the rates and making sure that the proposed increases are justified. So we're definitely going to look at all the testimony that we've gotten, as well as the recommendations from the exchange and everybody else. So again, thanks all three for your testimony. Really appreciate it. Okay, so next witness is Greg Rett. I don't think he's here. Colleen Gerner. Bernadita Yuns. Michael Robinowski. And again, I apologize if I mess up anybody's name. Please correct me when you get to the table. Again, I do apologize. And Sarah Cormini. Okay, please start when you're ready. And again, identify yourself just for the record. And again, if you're representing an organization, please state the organization. And again, just to remind everybody, we are taping as well, videotaping as well. Not streamlining live, but we are taping and eventually show it on our website and possibly on cable TV as well. So please, when you're ready, thank you.
My name is Bernadita Yunis. I'm a DC resident, also have my insurance through the DC HealthLink and with Care First. I won't speak for very long. I think folks have already said a lot of what I want to say. I'm a 31-year-old. I also have multiple part-time jobs. I'm a professor at GW. I work retail. I have multiple things that I do just to, make ends meet and be able to pay all the bills here in DC. My insurance went up. I started with my insurance through the DC HealthLink 2 years ago when I lost my last job, my last full-time job. And it was a high price when I started at $275, and then this year went up to $318, and that has already just been very difficult when, I'm basically like putting together lots of different paychecks just to pay the rent. And so I am very concerned because my income is not necessarily going to increase over the next few months, and I'm looking at how I'm going to go back to school at some point in the next year and a half. And so I am concerned as to how I will be able to afford and to continue to afford healthcare. I definitely depend on it. I'm not an extremely sick person, but I do have allergies and mental health things that I need continuous support. I'm I've been a resident in DC for over three and a half years, and I've been able to build up a really great network of support and medical care that I really depend on. And part of the reason why I want to continue to be a loyal Care First customer is because all of my caretakers and medical care take that insurance. And Care First does have really great programs that have helped me with some cost sharing, but even at that, with that support, it's still so much. And what I can read from the numbers, I'm looking at about $100 more that I'd have to pay every month next year. So I am deeply concerned about this, and do want to echo what everyone else has said to ask anything that can be done to keep that at the lowest amount would be possible, because I know that I have medical needs or things unforeseen where, you know, I end up getting really sick in winter and end up in the hospital, which is what happened last year. And so those things will definitely impact, and I know that I need the best medical care accessible to me like everyone else wants to have, and I don't know how to sacrifice that, and I don't know what to pay less of because I can't not pay my rent. And I think folks have kind of said all of that. So I just want to echo it that I definitely have the same concerns, and I appreciate very much the opportunity to get to be here and give this testimony, because I know the more voices will make the most impact. And I really appreciate you taking the time to hear us. Thank you.
Well, thank you for taking the time to come and testify. I really appreciate that, Ms. Eunice. Thank you. When you're ready, sir.
Good evening. My name is Michael Roboleski, and I'm an independent certified financial planner here in DC. I help people make sound financial decisions, with healthcare being one of them. I don't sell any financial products such as investments or insurance policies. Prior to starting my financial planning business, I was in charge of consumer education at Consumers Union, the publisher of Consumer Reports magazine. I led their research efforts to understand how consumers shop for health insurance. The NAIC, National Association of Insurance Commissioners, relied on this research when it developed the 2-page health plan summary document required by the Affordable Care Act that was then under the leadership of then Maine Commissioner Mila Kaufman. I also purchased my individual insurance on the DC Health Link. My focus is on the originally proposed rates of Care First and GHMSI because they have the largest market share on the DC Health Link. They both market their plans as blue plans, and I'll refer to both of these companies as Care First. I'd like to make 3 points about Care First HMO and PPO proposed 2018 premiums that I made in my written comments that I filed on July 21st. The first point is, how do consumers shop for health insurance among Care First products? Second, how Care First HMO and PPO rates as originally proposed were upside down. And third, how the premiums are unfairly discriminatory because they set different prices in the individual and small group market for the same plan. My first point is that consumers focus on 2 features when they buy health insurance. They look for the type of policy, whether it's an HMO or a PPO. They understand that HMOs are less expensive than PPOs because of the limits on their choice of providers and possibly their need to get referrals. Consumers reasonably believe that Care First HMO products, Blue Choice, and their PPO products, Blue Preferred, are interchangeable. An insurer with the word blue in its name provides consumers certain reputational benefits, namely that the insurer can pay its claims and that it has a wide network of quality providers. Consumers then balance the premium cost with the deductible. They understand that they'll pay a lower premium for a plan with a higher deductible. Thus, they choose among Care First PPO and HMO products on the premium cost and the deductible amount. Please keep this consumer behavior in mind as you review Care First and GHMSI's proposed rates. My second point, and I do believe some of this has just been rectified in terms of the ongoing discussions with Care First, but that the proposed premiums as originally proposed, Care First HMO premiums were higher than they were for the PPO. It's upside down. As originally proposed, the base rate for a silver HMO plan was $420 a month, compared to the comparable PPO plan of $381 a month, a near $40 difference. HMOs should be less expensive than PPOs, and in my mind, substantially less expensive than PPOs, given the restriction on the benefits. It sounds as though this issue has been addressed in the rate review process so far, but please scrutinize why the HMO rates are not more substantially lower. I think Mr. Dillon indicated they were 6 to 7% lower.
If you'd like to testify, just press 00 on the keypad on your phone. If you want to testify, please press 0 to the people listening on the phone. Thank you.
I believe Mr. Dillon indicated that they were 6 to 7% lower. The HMO rates were 6 to 7% lower rather than a 20 to 25% lower for the HMO product compared to the PPO product at the same metal level. My last point is that the same product, for example, a PPO silver plan, is now priced differently depending upon whether the consumer is in the individual or in the small group market. People are people. It doesn't make sense that the base premium for a silver HMO plan costs $420 a month in the individual market, but $340 in the small group market. As I said, people are people. This proposal is unfairly discriminatory because the consumer pays a higher price because they're self-employed or that they work in a small business. It seems much more rational to spread the risk and ensure that the same product is priced the same way, regardless of whether the consumer buys it as an individual or as an employee of a small employer. I urge you to explore ways to achieve that result within the confines of federal law and to recommend changes to DC law in order to do so. In sum, in your review, please make sure HMO rates cost substantially less than PPOs, and that the same plan costs the same regardless of whether it's purchased in the individual or small group market. Thank you for the opportunity to present my views.
Great, thank you very much. Really appreciate that. It was very helpful. You're ready, thank you.
Thank you. Thank you very much for the opportunity to provide testimony today related to the insurance rates for next year. My name is Sarah Cormany, and my husband and I have had plans on the DC exchange and the individual market since 2014. Right now, I'm paying $320 per month for a high deductible health plan. That means I have a $5,000 deductible at the bronze level, and my husband has a similar plan he pays because he's older than me, over $400 a month. I'm grateful that the plans we have do provide us with good coverage and that we have access to good health care. However, at these prices, our family of two already spends over $8,000 each year just to have coverage, in addition to several hundreds each year for covered medication and doctor visits. When you add it up, we could spend over $18,000 per year between the premium and the deductible if we had even modest medical issues. And I do really feel, just especially listening to other people here, that I wanted to stress that we've been talking mostly about the premium rates. An awful lot of these plans are rather high deductible plans. At one point I had a $6,500 deductible plan on the market. There's a lot of money. The premium makes up only one part of our cost, of course, and so we're really just talking about the premium here is excellent, but all of us as consumers are looking at all of these costs together, and it's a great deal of exposure. Even paying a high premium rate, I still have a high level of exposure in my potential costs. So I'm very concerned for myself and for my fellow exchange plan holders, given the proposed spike in premiums. And until open enrollment, I won't know what shape the new plans will take in terms of the deductibles, my doctor choice, or my covered medications. And so I'm going to have to look at all of these factors and really, I suppose, look forward to doing so and comparing the Kaiser and CareFirst plans available to me. I do feel that drastic premium increases, of course, are not affordable to self-employed individuals or their families, or to all of us who buy coverage through the marketplace. And I hope you will address our concerns and work with insurers, consumer advocates, and their representatives to set affordable, fair prices on the marketplace. Thanks again very much.
Great, thank you all three for taking the time to come and testify today. I take it that you all three would approve and recommend that we follow the recommendation for the exchange to phase in the CareFirst rate increases?
I believe that they were talking about that 16.4% increase and rather than a phase-in, and I'd be more in favor of the 16.4 as well, which I think the last panel, all of them had agreed on that, but I would agree with the last panel.
The phase-in makes sense.
And then you had mentioned that the HMO and the PPO should be priced differently. And I guess with the current, I think with the current filing, they would be priced differently, but then you're thinking there should be a higher delta between the two?
If you could make the HMO product more affordable by increasing the delta, yes.
I would agree with that as well. I have an HMO, and I mean, I picked it because it was cheaper, but my options are so much more limited. And even with that, I'm finding myself this year, because my copays and everything has gone up, that I'm trying to avoid going to the doctor as much as possible, even when I know I need to for different reasons, because even those copays are, I mean, a $50 copay for a specialist is a lot for me right now. So just, yes, please.
Well, thank you again, all three of you, for coming. I really appreciate it.
Thank you.
Thank you.
Thank you.
I'm going to try some more names again. So again, I apologize beforehand. Jody Carnaciani, Nicole Quiroga, Elena Jarwin, all right, again, thank you very much. And we get started. We'll go again from my right to my left. And again, if you can introduce yourself, and again, whether or not you're an organization, please identify the organization. So when you're ready, thanks.
Commissioner Taylor and other staff of the Department of Insurance, thank you for the opportunity to testify today. My name is Jody Corciani, and I'm a health policy analyst at the DC Fiscal Policy Institute. DCFPI engages in research and public education on the fiscal and economic health of the District of Columbia, with a particular emphasis on policies that affect low and moderate income residents. I am also vice chair of the DC Health Benefit Exchange Authority's ACA Advisory Working Group, a broad array of participants working to develop consensus recommendations for local policy interventions in light of potential regulatory and administrative actions at the federal level that can impact the district's marketplace. I want to thank DISB for holding today's public hearing. Although proposed rates are submitted and reviewed yearly, this year is the first opportunity that stakeholders in the district can meaningfully comment on this process in an open, transparent way. We thank Commissioner Taylor and the staff at DISB for spearheading this initiative and hope that this hearing becomes a continued practice by the agency for years to come. We also appreciate the efforts of the DC Health Benefit Exchange Authority, which continues to advocate year after year for the lowest possible rates for DC HealthLink customers based on their findings from the use of an independent actuarial consulting firm. I'd like to comment today on the most recent proposed rate filings for 2018 and also offer several recommendations on how to further build upon the public rate review process in the future. The DC Fiscal Policy Institute shares the concern expressed by many others about the size of many of the proposed rate increases and what that would mean for district consumers if approved. The proposed rates in the individual market include increases upwards of 36% for some plans, which could be a huge hit for consumers. I'm concerned that rate increases of this size could lead many consumers to forgo coverage and pay the penalty. This is particularly important for the individual market in the district, where most consumers bear the full cost of insurance without subsidies or tax credits. To be clear, rates change year over year for a variety of legitimate factors, and carriers do their best to reflect these factors and price products adequately. However, as a matter of public policy, the proposed rate increases for 2018 must be considered in light of their impact on consumers this year, as well as the potential for longer-term ramifications. As noted, large rate increases could lead to more residents forgoing coverage, particularly those in good health. This would shrink DC's insurance pool, making that pool more risky and creating market instability. In other words, sharp rate increases this year could lead to even higher costs or reduce margins in future years. We therefore hope that DISB will weigh the legitimate business interests of insurance carriers with the equally legitimate concerns of consumers, with the goal of approving rates that lead to a robust risk pool and a stable, healthy, and affordable market. We believe that this would mean scaling back some of the largest rate increases. Beyond this, we'd also like to offer recommendations on how to build upon the public rate review process into the future to create meaningful and vigorous public engagement. First, we encourage you to consider having a public hearing earlier in the process, such as in June after proposed rates are filed, with an earlier announcement to encourage public commentary. We also encourage a robust plan for advertising these public hearings. This could include outreach through DC government online and social media channels and direct DISB communication with stakeholders. Lastly, we ask that you make all preliminarily filed documents and final approved filings available to the public online, unless restricted, of course, by DC confidentiality laws. Furthermore, we recommend linking these documents in press releases or other announcements of public hearings for easy access. While we understand that DISB receives many documents, many documents, including frequent revisions, we think that this is important to post them all. As the insurance regulator for the district, it is DISB's duty to ensure that residents and small businesses are provided rates that are fair, adequate, and are not excessive. Working with both carriers and public stakeholders to ensure a deliberative and open process and maintain the vitality of our market is something I'm very confident that DISB can do. Thank you for the opportunity to testify, and I'm happy to take any questions.
Great, thank you very much. Please.
Thank you, Commissioner Taylor, for this opportunity to speak before you. My name is Nicole Quiroga. I'm the new President and CEO of the Greater Washington Hispanic Chamber of Commerce.
Welcome and congratulations.
Thank you so much. It's really my honor. As you know, the Chamber represents Hispanic and other minority-owned businesses who choose DC as their place of business and often home. It is my responsibility and passion to speak on behalf of our members, the great majority of which are small businesses. I'm here to advocate on behalf of them for full and continued transparency in the rate review process and for the lowest possible rates for our small businesses. With the involvement and support of DC HealthLink, the Chamber has been able to play a vital role in connecting individuals and small businesses to affordable healthcare plans. In order for a community to prosper, it is critical for business owners to have an understanding of and access to the rate review process and filings, especially if rates are going to be increased, which could have real and detrimental impact on small businesses in the district. At the very least, full transparency will allow business owners to protect future stability and profitability. I do want to thank you for taking the time to listen to those who have a vested interest in the Washington, D.C. business community. It is through transparency and comprehensive affordable rates that we can continue to count on the success of the DC Health Benefit Exchange Authority and all DC small business owners. So in the end, it is our hope and our strong request that DISBC approve a substantially lower rate increase in 2018. Thank you for the opportunity.
Thank you very much for your testimony.
Good evening. How's everyone?
Great, thank you.
Thank you for giving me the opportunity to speak today. My name is Ileana Jaron. I am here today on behalf of our General Agency Insurance Marketing Center to provide you with my observations regarding the consequences of potential rate increases to the citizens and small business employees of the District of Columbia. I am in a unique position as a DC HealthLink broker liaison. I work closely with DC HealthLink, brokers, the carriers, small business owners, HR managers, group administrators, and also the employees during their open enrollment season as well as off enrollment season. There are two sides to every coin. One side is the carrier side. We know that they need to make money and pay the doctors that work on their networks, employees of the carriers, and to also pay for the rising costs of medical treatments to their members. Cancer, transplants, AIDS, heart disease, high blood pressure, diabetes. These are just a few of the high-dollar medical costs that the carriers pay for through health insurance. That is why we have health insurance, so these medical conditions do not bankrupt members. On the other side of the coin are the recipients of health care, those who pay for and use those services. Small groups have received the biggest impact of rate increases, as well as individuals. In our office, we have seen firsthand how high rate increases can affect these small business owners, their employees, and individuals in providing sufficient coverage for them. Where once business owners offered high benefit plans covering the entire or majority of the monthly premiums, today they are now offering lower benefit plans to their employees and reducing the contributions to their employees to cut costs. I have seen employees decline coverage because the premium was too high, even with a 50% contribution from their employer. If employees have dependents, then it becomes even more expensive for the employee, and sometimes the company does not offer to contribute towards those dependent premiums. What would be the repercussions of high rate increases for small groups and their employees? For both, the result is the same. Employees choosing higher deductible plans than what they currently have just to decrease the premiums, and small business owners declining to offer their employees dependent coverage and choosing an even higher deductible plan as part of their offerings, which will include higher out-of-pocket costs. While these decisions will lower the premium, it will increase the burden on the employees to pay more out-of-pocket dollars towards their health care. For employees making less than $20 an hour, between paying for rent, mortgage, food, clothing, transportation, and health care costs, they will be hard-pressed to keep a roof over their heads. I know that is something that no one wants to happen. I have seen employees struggle with the decision of, can I afford this health care coverage? What would be the cheapest options for me? And staying with the same coverage that they are with, but not being able to pay for it. Everyone should have access to affordable health care in this country, even more so in the District of Columbia, where our government is based and can give some measure of control to these rates. Thank you very much for listening to me today.
Thank you very much, Ms. Jaron. Really appreciate the testimony. And Ms. Korchani, right? I got it right this time? Yep. And thank you for your work with our Health Advisory Committee, Subcommittee. Really appreciate that. And you sort of beat me to this. So as folks have said, this is our first time we've had a rate hearing in the district, and we're going to do many more. And we also plan for the next round of rate review next year. Once they come in, we're going to have a hearing when the rates come in the beginning, and then also have one around the time as we start finalizing the rate. So again, it's really important that, again, as you mentioned, Ms. Kiorga, yes. As you mentioned, transparency is really important, and we really want to engage the public more than has been done in the past. That's the reason why we started the hearing, had this hearing today. So really, again, appreciate the testimony, and we're to take those comments and go back as we scrub the numbers to make sure we get the lowest possible premiums possible for the consumers in the district. So again, thanks very much.
Thank you, Commissioner.
Thank you.
Thanks. Keep going down the list of the witnesses that signed up. The next one is Peter Semler, Denise Hahn, Karen Mack, Katia Lind, Al Goldberg, fantastic. Thanks so much. And Mrs. Sumner, when you're ready to get started, again, introduce yourself at the beginning. If you're representing an organization, please identify that.
Hi, my name is Peter Sumner. I'm a DC resident, also business owner. I'm an individual member of Kaiser Permanente. Just to start aside, we should have a pre-actuary program for our DC high schoolers. Actuaries make $80,000 straight out of college. It's a good job, man. It's a good job. What I'm going on to is I'm speaking to you as a regulator. Kaiser Permanente healthcare delivery is fantastic. It's a model for the country and for the rest of the world. Efficient, no wastage. You go in there, you get your appointment, MRI, you're in and out. Fantastic. The staff, half of them have served our military. Perfect people. We have one Capitol Hill, a couple blocks away from the Senate and the House. They can see how healthcare, efficient healthcare works. We have one on the other side of Northwest. And I find the healthcare delivery great. However, when we do with administration, this is a big problem for all our healthcare providers. And the administration cost is something that we shouldn't be burdened with. It's high. What you don't see, you don't need. And with Kaiser Permanente, instead of being able to resolve things that are relating to insurance that are regulated and licensed by DC, District of Columbia, they do not act or work in the District of Columbia. Last year I got booted out of my Kaiser Permanente. I'm 51, maybe at risk, in a 2018 area code. And the letter's from Tampa, Florida. I guarantee you guys, I went to the health thing, resolved. The regulation works. But how many other people have done this who got booted out of the service, might not have internet skills, might not know how our government works. So what I suggest is anybody who's licensed in DC must operate in DC. We have dispute resolutions. They got Rockville. Why should DC residents be paying a cost center in Rockville, Maryland, or wherever when it doesn't come to us? My bet, put one or two people in any of these guys who can do all the dispute resolutions empowered, we'll see administrative costs fall completely, better service, because as we see, we are now the model of the country, and we can do this. You know, DC is the District of Columbia. You know, we're federal, we're national, we're even sometimes global. By doing this, we can show that we can lower the administration costs. I'm about to hire 10 people in the next, hopefully next few months. This healthcare cost, the outrageous cost, is becoming a tax. Do we hire in Canada or Mexico? Because that saves us $10,000. This is a serious problem on both sides of the aisle, and it's a huge tax to employers. So we need to get our premiums down. Kaiser's shown its way on the healthcare. Everybody can improve on administration. This is a cost that's gone out of control across the country for the last 30 years, and this is something that we can do immediately. Thank you for your time and your patience, sir.
Thank you, Mrs. Sommer. Really appreciate that. Ms. Mack?
Good evening, Karen Mack Management Consultants. I'm an independent consultant and am very concerned about the increases in healthcare. I've watched my healthcare, I'm 57, and I've watched my healthcare go from $100 and something a month years ago and always paid it and always been with Care First, till now I'm paying $479 a month just for the premium. Nothing else. And it is cost prohibitive. So I do believe that everyone is entitled to health care, but affordable health care is not affordable for everyone. So I come to speak without prepared notes, just from the heart that something should be done. I appreciate hearing about what you are doing, because it is prohibitive for folks. I mean, I learned so much in just sitting and listening to other people this evening, but between a group, I tried to get in a group, can't get in a group, can't even find a broker through through healthcare. And I'm on DC Linked as well, and they told me, I was shocked, that brokers don't deal with people in DC because it's so complicated. I'm telling you what I heard. I'm testifying. Thank you. And so it is, these kinds of things make it very frustrating and very aggravating. And as someone who's always paid for and is healthy, it makes me wonder, what if I just let this go and pay the penalty like someone else said? I'm thinking of moving from Care First to Kaiser, because if they go 39%, I can't even believe that is speakable, to do a rate and to have a rate increase that way. So I appreciate being here, hearing, learning about it, and just know something has got to be done.
Well, thanks very much, and thanks for being here in your testimony. Mr. Goldberg?
Good evening. My name is Al Goldberg. I am the founder of Mess Hall, a small business located here in Northeast DC. Mess Hall is a food incubator, which means that we're a home to over 40 different small businesses which operate their own food businesses out of our business. I too am speaking anecdotally this evening, just as sort of a face of a small business who subscribes to DC HealthLink. Proud to say that by the time these increases come around, we should be 10 employees strong. We started with DC HealthLink on employee number 1 because I believe that everybody should have affordable health care as well. Some of the stories that I've heard here from individuals have been heart-wrenching. It reminds me why we as a business subscribe to insuring health insurance for my employees. I want them to come to work healthy and ready to work, and to be able to get well when they're not. But when we see these kinds of increases, the toll that it can take on a small business should not be ignored. So please be mindful of that, of the repercussions that will naturally happen to these small businesses. And I do think that the small businesses are the heart of the District of Columbia. We have a very strong economy built of small businesses. We employ a lot of people and a lot of our own DC residents. So what are the repercussions? Well, do we discontinue providing health care? Do we not hire as many people? I mean, I can't jack my own rates up 10%, 45.9%. I mean, and I hate to, it's just like, I come in here and, you know, I'm not desensitized to these numbers, right? The way that some people maybe in the industry are, with all due respect. But in what other industry can you force your product on? Will you have a product that's so needed and that the people paying for it have no choice but to not only purchase it, but then to subscribe to these ridiculous increases? Good morning, your rent just went up 46%. Good morning, we're going to make that more palatable by phasing that in. So your rent is now, it's going to be 46%, but let's maybe spread it out over like 3 years or something, and you won't feel it as much. I mean, if I go to the grocery store and I see that the prices have jacked up 40-something%, I mean, what am I going to do? Either not eat, or am I going to wait next week until Cheerios go on sale? Well, I don't think insurance is going on sale next week. It's just such a, I just can't comprehend this because this isn't my industry, so you'll have to forgive me, but I'm coming to this maybe as an outsider, but hopefully as a cold reminder that we need to take a look at the forest through the trees. You can't jack anything 10, 15, 13% and expect that it's going to be sustainable for the people that need it. And thank you to all the people who offered their testimony tonight to remind us all what a difficult position that some of these things put us into. And I'm going to try and continue to offer a contribution. We contribute half contribution to our employees' plans. I can't do anything for their dependents right now. I would like to, but I won't be able to if it continues in this direction. And I hope that that you will keep premiums down as much as humanly possible within the realm of reality. Thank you.
Thank you, Mr. Goldberg, and thank you as a small business. And I've actually been to your business a couple months ago, so really great work that you do over there. And really, I mean, small business is really important to the district and to the economy, as well as to people that you employ. So we really appreciate that, and we're again work as hard as we can to get the prices down to a level that's as low as possible. So again, thanks very much, all three of you. Appreciate it.
Thank you.
All right, going back through the list, John Lever. Kathy Braxton. Robert Nathan. Jack Inslee. Martin Stupak. Jennifer Delapama. Michelle Jackson. You might have to do everything yourself.
Hey, I'm ready.
Janice Davis. Emmanuel Wilson. Oh, I'm sorry, there's Janice Wilson. Emmanuel Wilson. Kara Holes. Okay, I got you some company.
Okay, good, I'm ready.
All right, when you're ready to start, please introduce yourself, and again, if you represent an organization, please state the organization. So,
Good
Ms.
evening.
Braxton, thank you.
Good evening, Commissioner Taylor. My name is Kathy Braxton. I'm a native Washingtonian. I am an independent business owner, and I'm self-employed. I don't have any prepared statements. I got an email yesterday from, I think, the Health Link telling me about this particular meeting today, and I felt so strongly about it, I decided to come here and put a face to an individual receiving health insurance through DC, through the DC Health Link. At this point in time, my premium monthly is $570 a month. I too am one of those Blue Cross Blue Shield persons that have had Blue Cross for years and I don't want to deviate from Blue Cross Blue Shield. But I'm concerned about a 24% increase. At $570 a month for one person, I can't afford a 24% increase. Healthcare is supposed to be non-discriminatory, and it's supposed to be not excessive, and it's supposed to be affordable. What's being proposed today does not fit within any of those categories. And so, to the extent that your team can do anything to alleviate these costs, I highly ask that you do so. What I did find interesting here today is that we have a lot of self-employed people coming up here because we're the ones who are bearing the brunt of this. And it's almost like I feel like I'm in a fight now, and I don't know if I'm going to be able to win it. Like at this point, I'm contemplating marrying a family friend just for health insurance. Like literally, that's where I am. So what I thought, I'm serious. So what I thought is kind of interesting is that we have all of these self-employed individuals here. Has there ever been any discussion, and I'm sure it has, I'm sure you thought about all different types of scenarios, but has there ever been any discussions about trying to combine all of these self-employed people into some sort of small group plan? Maybe at that point things could be made affordable, because what you're proposing here today, and I'm happy that the Health Link is here and asking for a gradual increase, but at $570 a month, even at 16%, you know, I have to ask myself what it is I'm going to have to give up. And of course, I do have a gold Blue Cross Blue Shield plan. I started off with a bronze plan, but because of a health scare last year where I too had to deal with the breast cancer situation, I had to increase to a gold plan just to make sure that all of the extra bills were going to be covered. So what I'm here today is just that, one, just put a face to what's going on in the industry. We hear all of these numbers, and the numbers are excessive, but it's not the same thing as actually having to look people in the face and having them to have to decide between, do I pay health care or do I pay a mortgage? And that's literally where individual self-employed people in the District of Columbia are today. Thank you for hearing me.
Thank you, Ms. Braxton. Really appreciate that. Ms. Davis?
Yes. Good afternoon, Commissioner Taylor and department representatives. Thank you for convening this public hearing on the 2018 proposed rates for individuals and small groups. I'm Janice Davis. Today I come before you as a representative of my association, the National Association of Insurance and Financial Advisors of Greater Washington, D.C. Our association is a 125-year-old organization dedicated to political advocacy, promotion of ethical standards, and professional advancement. Our members serve the needs of the residents and businesses of the District of Columbia. Over the years, our organization has developed strong community ties and has created a foundation which donates to charities and causes in D.C. and the surrounding area. I am a D.C. business owner, small business, a fourth-generation Washingtonian, an insurance broker of 30-plus years. Thank God I am on Medicare and do not have to do this. I'm only 65-plus. Our company is a D.C. corporation now located in Ward 4 and is a financial services company. Our benefit practice primarily serves both the individual and small and middle-sized group market in the metropolitan area. As partners with DC HealthLink, the brokerage community has worked hand in hand with our residents and businesses to advise, enroll, and service our clients through product selection, claims, appeals, billing, and assisting them in conforming to regulatory requirements. Often, this service is rendered without compensation because many of the inquiries lead to Medicaid enrollment. This year, we will no longer service one of the major carriers because our commissions and our access to client records have been eliminated because they've decided, this one particular carrier has decided that brokers are no longer necessary. As brokers, we represent several carriers and advocate on behalf of our clients. We are licensed professionals required to complete continuing education, carry E&O coverage, and are subject to regulatory supervision by your department. The district is unique among many metropolitan areas because it has developed programs and a safety net for most of its population through a wide variety of service providers. For those who already could not afford insurance prior to the enactment of the Affordable Care Act, or ACA. The ACA has greatly expanded the opportunity for more residents to have coverage through Medicaid expansion and subsidies. Over the past several years, our firm, like many other brokerage firms, has been certified as a broker on DC HealthLink for individual and small group residents. Through DC HealthLink, we have acquired several new small business clients who have never purchased insurance before, but wanted to provide medical care to their employees. Many elected silver or bronze high deductible plans, paying 1/2 of the monthly premium for some. This payment was a very large portion of their operating expenses, especially those with older workers, since all plans are age-banded. Next year, many of the groups will experience 7 to 13% rate increases. Although these increases are better here than in many jurisdictions, the new rates will greatly impact employers' bottom lines, and employers may elect to discontinue their coverage, choose higher deductible plans, or pass along rate increases to their employees. As an employer, I too will have to make this decision. Currently, I pay 100% because I just think it's such a wonderful thing, but as my employees get older, their premiums rise, and if we have substantial rate increases, I don't know where I'm going to go next year. Individuals who enroll on this exchange may face proposed rate increases as high as 39.6% and elect to drop coverage, especially the younger healthy ones, because it becomes too expensive, or again elect higher deductibles that do not suit their needs. I see a lot of clients who come in and can only afford a $4,500 deductible plan. We have large incidences of diabetes, cancer, et cetera, and their medication. In order to meet a $4,500 deductible plan, it is impossible for them to afford their medication. We have great confidence that DISB will review the rates to see that they are fair and justified. Thanks again, DC HealthLink and the Actuaries. You've done from yesterday to today, provided a miracle, and I do like the idea of not phase-in, but 16%. I do think that 39.6% is absolutely unreasonable, and the gentleman was correct about HMO and PPO. These are totally different kinds of plans. The HMO should cost less. It's got a narrow network. PPO doctors are the preferred providers, and they also have a national network, so they did it upside down. See that the rates are fair and reasonable and affordable. As financial advisors, we know the importance of quality, affordable medical care coverage is very important to the health, the wellness, and the prosperity of our own community. We trust that you will consider all factors, including the value of expert professional advice, in making your decisions. We appreciate our partnership with both you and with DC HealthLink. Thank you.
Thank you very much. Thank you very much, Ms. Davis. Appreciate that. And Ms. Holes, when you're ready, please begin.
Thank you, Commissioner Taylor and members of DISB. Thank you for this opportunity to comment on the proposed health insurance rate increases for 2018. My name is Carol Hulse, and I'm 48 years old and a resident of the District of Columbia. I have held a policy on DC HealthLink with Blue Cross Blue Shield, the individual market Blue Choice plan, since 2016. As an independent contractor, the ability to purchase this insurance through the DC Exchange has been a great resource. Currently, I work as a contract tour guide. I have a Class A tour guide license in the city. I'm actively involved in a new business venture, And I work part-time at a local hardware store to have a steady income. My income varies greatly, but it has been enough over the last 2 years to pay my mortgage, to buy dog food, and to generally support myself. None of these employment situations provides health insurance, so therefore I purchased my insurance through the DC Exchange. I have found it to be good coverage, excellent coverage, as a matter of fact, and I'm grateful to have it. In November of 2016, I joined my fellow sisters being diagnosed with breast cancer. I'm 1 in 4, 1 in 5. Ladies in the room, pay attention. This diagnosis came as a result of a screening that I probably would not have done if I didn't have health insurance. I credit that test with detecting the cancer early enough to have it treated comprehensively. And opposite of the lady who spoke first, I do credit it. I don't think it's too dramatic to say that it saved my life. Obviously, I see the value of having health insurance and will in fact need to keep it consistently going forward, as cancer is a pretty big pre-existing condition. In 2016, my premium was $298 per month. In 2017, it increased to over $100 to $405. Based on the 39% number that I was doing the math with last night, it would make it $562 a month. Even going back down to 24%, it's still $100. 16% is about $70. I don't do math very well, somewhere in there. So in 2 years, it's increased over $200 a month. My income has not increased that much and will not, even if this business venture takes off. So I'll need to evaluate, where is that money going to come from? I've already cut nearly all of my discretionary spending. I'm working 50 to 60 hours a week. I'm relying on the generosity of friends and family to help cover my portion of the surgeries and treatments that I've had over the last 6 months. So in addition to putting my mortgage at risk and some of the other suggestions that people have thrown out, in the back of my mind, I'm thinking back to 2015 when I was on unemployment. I qualified for unemployment due to a job change, and I also qualified for Medicaid. And that was really good insurance. That was great coverage. Took a while to get doctors, but that was good. So if I lowered my income $6,000, I might qualify for that again. So here I am, a motivated, educated person, and I'm considering not working. And I think that's very sad. So I understand that increases are necessary, but I think that Blue Cross has more flexibility in their budget than I do in mine. So I would encourage you to please consider lowering the increases and be more in keeping with something like CPI or increases to the minimum wage or something that's relevant to me, that makes sense to my math. If you'd indulge me, I do have an additional question for Mr. Dillon. I think that's who would be the one to answer it. Earlier when you were explaining the different increases, you talked about there's 4 to 5%, I called it inflation, that was my word for it. 3% that was this new fee that's come back. And then this other part was something to do with redistributing, I wrote down gains that company made to the entire market, something to that effect. And I'm wondering if the company, Blue Cross Blue Shield, for example, has had a healthier pool of people and made that money that they have to pay to someone. Why am I paying that in my rate increase for next year? Isn't that money that they have?
Yes, I think you're talking about the risk adjustment that Mr. Dillon spoke about, so maybe I'll ask Mr. Dillon if he could sort of provide a little more information on that.
Yeah, so as part of that, with the risk adjustment, it is because of guarantee issue. You know, the risk adjustment program is set up so that the carriers that do have the healthier people and they're charging this amount and they get healthier people, they don't get to keep that money, okay? So that assessment is done based on their current block of business and projected forward. So that rate increase is basically saying that their population of healthy versus sick people is different than it was what they expected. And so because they're expecting this new population, that they didn't originally expect, so now it's a different mix, they have to charge a rate based on this new mix that they think they're going to have in 2018. And so that new mix is a different blend of healthy and sick than they originally expected. And because of that, they have to pay more into the marketplace based on this different mix.
So if I could just put it
Yeah.
into my words to make sure I'm understanding, the companies think there are going to be more sick people, so they'll have to.
The distribution of the healthy and sick people within the DC market have shifted between the carriers. And so because the distribution of the healthy and sick for each carrier is different, then the funds are transferring differently for 18 than they have in the past.
Okay.
Yeah,
I still don't quite understand.
It is a very complicated, actuarially speaking, it's one of the most complicating formulas we have, so it's kind of hard to communicate in simple terms. But it's essentially that the sicker companies don't have to take that big hit. They get money from the companies that are healthier, and that has changed. And so as a result, the premiums that the carriers are charging is changing because their mix of healthy and sick people are changing.
Okay.
All right, thanks, Mr. Dillon. Appreciate that. And Ms. Holmes, thank you. I'm glad that the ACA it saved your life. And that you're here to talk about that. I really appreciate that. Ms. Davis, if you can just sort of, you mentioned that you're a broker.
Yes.
And I'm wondering, there was some talk earlier about that Mr. Dillon mentioned that Care First had announced. I'm not sure if it's been finalized yet. I know they announced
It's
it.
not in the rate, so they actually cut it out.
Yeah, well, they announced it. I'm not sure if it's finalized yet.
Okay.
But tell me a little bit, and somebody mentioned here that they had a little issue about finding a plan or getting a plan and getting some help with a broker.
Yeah.
Maybe just give us just a quick summary of what you do and how your services are helpful to folks in the district, in the individual market,
Right.
where there's that notion that if they take away the commissions, might impact your service delivery in the marketplace.
Yeah, I think at our last large, and it's Care First, who does have they say a smaller share in the individual market, that decided to do this. And I believe we calculated it's just a very small amount of what the premium is. But basically, as a broker, people call me, and I do work with individuals as well, and they ask me which plan they should have. We work hand in hand with DC HealthLink, and we have a partnership, and this is how it was all formed. I mean, people have assisters, there are other people who work with it, but we're the ones who are licensed, and we basically work with this. If she called me and she told me, she said, we usually talk, and I said, well, do you have a particular doctor that you do not want to leave? And they say, yeah. And this is on the group market as well. And we take a look at those networks, we look at where the networks are. If they don't want to leave that doctor, we make sure that they get that doctor in their network if I'm talking to a group. And that's the other beauty of DC HealthLink, because it offers a lot of different plans that you can pick in a company. We basically only have two choices. What people primarily say is, basically, what do they cover my drug? That's a huge thing, and how much does it cost? We have a lot of people who come in, especially because we're DC, and they can probably tell you, Margarita, who is also a broker, was not here from the Hispanic caucus. We also have a lot of ethnic groups who don't even understand our insurance. I mean, if you're coming from a country that's got a single-payer system, you're looking at a whole different kind of system. So we really have to tell them how it works. What's a co-insurance? Well, what is a maximum out of pocket? I mean, it's so many times. It's hard enough for people who know insurance to know exactly what this means. So we go through the whole process with them. Most of them, because the DC HealthLink has truly improved its process, can go online and see. But they have very specific questions, some things that they don't want to share. I need psychological counseling. Some people basically say, well, you have this narrow network of psychological or psychiatrists that they work with. We really get into the weeds. Basically, if a person has a claim, if a person doesn't get a card, one gentleman talked about the administration of Kaiser. Kaiser is not the greatest with billing and some of its administration, But, so we help in that instance. A lot of times people, almost all my clients have my cell phone number. At 5 o'clock and 6 o'clock when your agencies call, I get calls on Saturday from emergency rooms. I get calls all the time. I mean, that's just the kind of broker I am. Most of the people in my professional association are the same way because we took an ethical oath, and this is what we do. So, I mean, I guess basically the other broker here can tell you more, but we work from soup to nuts. We work in many different areas. There are people who've never had insurance before, and they're scared. They will say, well, gee, I got to get this insurance because I'm going to get a fine. Well, what does this mean to me? And they do make that choice. Well, this is just too expensive. We have people who are on, the children are on Medicaid, but they are taking something else. And the small businesses that I'm finding, especially through DC HealthLink, they want to offer this coverage. So we try to find a way that they pick a target plan and say, how much can you afford? I can only afford to pay $200. I just had a client today at $200 toward my employee premium. So we take a look at all of those things. We space it out. We take a look at this. But, you know, we just give individualized attention to our customers. Small group market is a lot more lucrative, but, you know, I'm an individual. I live here. If I looked at 39% rate increase, that's insane. So I tell people what the benefits of Kaiser. I mean, you may want to go to your doctor. It's not a clinic. It's an interesting mindset that we have in DC because we've got so many people in the federal government here who get to choose Aetna, United Healthcare, and everything else. And so, well, I don't want to go to a clinic. Well, Kaiser's not a clinic. You know, basically it's got it's one of the best systems around. So we have to talk to them. I said, well, you know, where do you live? What's the access? We had talked a little bit about this yesterday. I have people who never used a computer before. You have to enroll on DC HealthLink with a computer. I have a guy, I have to actually download a list of doctors. I say, what's your area code? Can you mail it to me? Or they come on the buses and they come to our office. So that's basically what brokers do. I mean, I've made a fairly decent living in that. That's not all that I do, but I enjoy it because I know that the medical insurance, as a financial planner said, this is one of the hardest decisions that you make. You're going to pay your premium because you know that something can happen to you. Yeah. I have mothers who call me and say, my son doesn't want to pay money. I will buy my son insurance because I'm not paying his bill. So, you know, I think we're a resource. I mean, I think it's been a pretty good combination. Maybe Mila can talk about it. And I think we were really shocked when they decided they didn't need us anymore because that's what we were trained for. I mean, that's what we're licensed to do.
So I guess it sounds like it's a very valuable service that you provide. So if they were to put it back and agree to pay commissions, that would increase rates overall a little bit.
It's just a tiny bit. 17% of a medical rate is prescription drug cards. We all need to sit there and take a look at what makes up a rate, although an actuary is doing this. But you've got a 17% load just for the drugs.
So it sounds like
it's a tiny portion of it. We can't quite figure out why they're doing it.
Sounds like they should put it back in then, is what it sounds like you're saying. And I know it's a little biased to ask a broker, but
I think we perform a service and we get paid very little for it. So
well, thanks again.
I think we're good.
Yeah. And Ms. Braxton, I know you mentioned something about people who are self-employed and how to get a group. It may not answer your question exactly, but one thing we're looking at is whether or not we want to merge the two markets together. I mentioned earlier we merged the risk experience, but we're also looking at now whether or not we want to merge the markets together. That actually might make the individual a little more affordable. So it may not answer your question exactly, but might start moving that right direction. So something we're taking a look at. So again, all three, I really thank you for your testimony and time today. Really appreciate it. Thank you.
Thanks.
Okay, I've been told somebody on the line has asked a question. They may not have heard my opening remarks, and Miss Lauren Stokes, I believe is the name. And I think the question was, and again, I mentioned earlier that we're going to finalize our work in this area I'm looking at all the public comments and recommendations, and we expect to make final determination on the proposed rate increase for 2018 by the end of the month. So that's what the time frame is, by the end of the month. Just to put that out there to, okay. And then I'm going to go back to the witness list. These are the people who signed up prior to the hearing. So we're going to take those first, and then, as I mentioned, any new people, the folks who are on the phone sign up, and then any new people in the room, and we're alternate back and forth. So just, again, that kind of keeps it fair for everybody. So I understand that people are waiting on the phone, but once they get about 6 more people, we get to the phone. So if you can just hold tight, and thanks for your patience, I appreciate that. And I'm gonna go back through the predetermined list and see if Mika Kidd is here. Micah, sorry. James Massey. Patricia Quinn. Sorry about that. Brian Smith. Catherine Sparks. Erica Addington. All right, thank you, Mr. Kidd. And when you're ready to start, please identify yourself for the record. Again, if you're speaking for an organization, please so state.
My name is Micah Kidd. I am currently rebuilding onlinehealthbroker.com. I believe I still am a preferred licensed DC Health Link broker. And I thank you guys for the opportunity to present today. Greetings and respect to all in attendance, and thanks once again for the opportunity to speak on behalf of both my experience and clientele. I've been a licensed insurance broker now for just over seven years. In my role as former producer relations manager for DC Health Link, and in my last role as senior business analyst at HCINF, I've served to enhance both public and private exchanges. Having this experience enables me to see things from a unique perspective. As recently as the implementation of the ACA, we have made a shift to shore up the insurance industry, whereas yesterday the bankruptcy courts were filling up at an alarming rate due to healthcare expenses. Fast forward to today, where this implementation has now taken root and people have done well enough to adapt to their premiums and understand their coverage, we must now do more to insulate and drive down costs for everyone involved. In representing my DC clientele, I find that people are getting used to the coverage, but the incremental increases are becoming a concern. I get comments like, if carriers are going to leave the market and cause rates to climb to pre-ACA levels, then how can we call that affordable? Before coming here today, I could assure them that that probability was very low, but things are a little different now. But we all get the point. We all feel it. I'm concerned that we aren't looking in the right places to shore up levity for our industry. Instead of embracing a new change with a different perspective, we are rusting the gears of progress by resorting to the age-old formula of simply raising the rates on the insured without searching for better answers to the bottom line. For example, exchanges in their design are created to provide efficiency, and where we find efficiency, we find savings. So working with the exchanges should create more savings to the carrier, which can then be brought to the insured in the form of a lower premium. We need more competition in the individual market to drive down costs. Currently, the individual market only has 2 choices for insured individuals. This scenario creates the condition for higher premiums simply due to the lack of competition and the dominant carrier that was alluded to earlier. This environment seems prime for our local politicians and lawmakers to create more efficiency by doing what we can to bring more diversity of choice and offerings to the exchange and its insured. I'm concerned as well that we aren't looking to make enhancements to the ACA that can help our carriers and hospital systems get what they need as well to create efficiency and bring costs down. I won't stand here before you today or sit here before you today and bring you an entire version of my efficient ACA and what that would look like, as we're here to discuss the premium rates and their relation to our policyholders. I will, although, sit here and tell you that during the ACA, we had town halls and hearings similar to this one. Insureds, brokers, carriers, and policymakers hashed things out to make the ACA what it is. Now that we're here, I'm hoping we can find collaborative efforts with all the parties listed above, and we can work together to make our industry greater than it's ever been. The truth is, our policyholders feel the pain. Our district residents all across the wards are feeling the pain. Business owners are feeling the pain. Increased premiums inherently create a strain on the family economy, and this builds resentment without the proper justifications. And we, the brokers, are running out of answers. Our policyholders are looking to us simply because they trust us to help them make the right decision. Although my role as a broker may be limited in the part I play in determining these outcomes of these rates, I still believe that through understanding, innovation, and collaboration, we can do the best we can to create efficiency for our industry and more savings to the insured. That being said, given some of the things that have been brought to my attention here this evening, dominant carriers are a force. They can swing around their ideas with greater push than the other guy who has less market share. They can make different kind of demands. And, you know, me as a broker, without naming the insurer, you know, it always makes me kind of curious if a formula for risk adjustment is not necessarily even keel across the board. So I'm left wondering if the individual market is currently inflated due to this error in this formula. In this merged market for the individual and the group, it's hard to explain this to my policyholders. If an actuary is finding difficulty explaining it to a policyholder, me as a broker, I'm going to have quite the time. And then when it comes to our commissions, as Janice had touched on earlier, we look to provide values to people. Sometimes it takes us 10 minutes, sometimes it takes us 2 days. But still, we face dwindling commissions from the beginning. And in an environment where one carrier is offering commissions and another isn't, it's going to slight the market. Most brokers, we are not going to be able to talk about the carrier who doesn't offer commissions. We're going to have to kind of sway and, you know, give them other options and talk about the other guy's features and to get them to switch from their doctors. But this isn't right. If they've been going to a doctor for all of their lives and facing 5 to 9%, why is that not so now? This whole commission thing is kind of like a farce to me, because the majority of policyholders, from what I can experience and all other brokers experience, they're not necessarily with us to the degree that they say. So there's more administration costs, and there's more that can be enhanced by the ACA, working with the exchanges, working with the brokers and the carriers to bring about a true solution. And please, please don't let those people on Capitol Hill not pay these bills. It will wreak a catastrophe through our industry. It will implode. Thank you.
Yeah, thanks very much for that, and we're trying to make sure they reimburse the carriers as promised. So we hopefully that they do that. Oh, please, thanks.
Okay. Good evening, Commissioner Taylor. I am Erica Wadlington, the Director of Public Policy and Programs for the District of Columbia Chamber of Commerce. I am pleased to be here today before you to provide comments on the filed 2018 proposed insurance rates for the District of Columbia. The District of Columbia Chamber of Commerce was established on June 20th, 1938, and for the past 79 years, the D.C. Chamber has been the voice of businesses in the nation's capital, Washington, D.C. Today, we represent approximately 1,400 member companies from establishments of all sizes and industries. Our members are mindful about providing a variety of benefits for their employees and are even more concerned about the Affordable Care Act and how any changes to this federal policy would impact their operations and affordable coverage for their employees. Recently, the D.C. Chamber of Commerce, in conjunction with CareFirst, convened a health policy forum this past June with an emphasis on Affordable Care Act and its impact on the District of Columbia. This event, which drew nearly 880 individuals from the business community and the healthcare sector who were eager to learn about the overall changes in the federal policy and the potential impact should it pass on DC residents and our local business community. Even though efforts have been attempted to repeal several provisions of the Affordable Care Act, there exists great uncertainty within our local business community as to how these provisions would impact compliance and benefit offerings for businesses of all sizes. No matter what happens at the federal level, small employers want a choice of insurers and health plans with the same purchasing power of large employers. As the federal act remains in a state of flux, the DC Chamber is here to testify and support the residents and small businesses of the District of Columbia in ensuring that the insurance rates of the district are fair and adhere to our local law. For the record, we would like to note that Aetna, CareFirst, Blue Cross Blue Shield, and Kaiser are members of the DC Chamber of Commerce. In addition, we partner with the DC Health Benefit Exchange to provide access to affordable care coverage in the District of Columbia for our small employers. As the Chamber has shared in previous public forums, we became a partner with DC Health Link in response to the business community's request for support in navigating the new healthcare system. The DC Chamber will continue to monitor your work for reviewing the health insurance rates. As you previously stated, Commissioner Taylor, the rate review process allows us to work with our insurance companies and to evaluate their proposals so that the district's insurance rates are adequate and are not unfairly discriminatory. I thank you so much for allowing the public and the District of Columbia Chamber of Commerce the opportunity to be a part of this process and for your thorough review of these rates. Thank you for the opportunity to testify.
Well, thanks very much for being here, and please tell President Orange that I said hello, and I'm probably sitting in his seat from one time, and Mr. Levi used to work for Mr. Orange as well, so please send us our regards, and thanks for taking the time to testify today. Mr. Kidd, can you tell me what the percentage of, if you know, the percentage of policyholders in the district currently that are using broker services? Do you know offhand, or?
The last time, prior to leaving DC HealthLink, it was less than 10%.
And then again, if commission would go away, what do you think would happen to that 10% of those policyholders? Do you think they'd be able to navigate by themselves, or do you think there's a possibility that they could become uninsured and then sort of add to the problem with the individual market, whereas you get less people in the pool, where that may have potential for, again, increasing rates and then helping with that vicious cycle?
Well, when you don't have commissions and you have no enthusiasm from the brokers to sell a product, you get less policies sold. A lot more public, given the increases and the lack of proximity to someone that can assist from origination all the way through, they would have to sit on the line, wait for the exchange. They may not feel like going through all that. So our commission is important to the industry. We're almost like free assistance to DC HealthLink when it comes to certain things. After a broker reaches a certain level of proficiency, they can help people out instantaneously. DC HealthLink is a virtual environment, so to take away our commissions is a travesty, because now again, I'm going to be slighting my business towards one carrier. There's not going to be as many policies issued, and then this puts a hole in our pocket. For all of the value that we provide to our clients and the information that we hold, we expect to have something to help us keep that business going. If you take that away from us, we're now just a little bit more de-incentivized to provide more support to the industry and hence increase insureds.
Again, thanks very much, Mr. Kidd, and Ms. Wellington, thanks for the partnership that the Chamber provides in sort of helping make our insurance market one of the best in the country. So thanks very much.
Thank you.
I think we're now turned to, I think there may be a witness on the phone who wants to make comments. Okay, so we're looking for Miss Deborah Brown, who's on the telephone, and I understand that she wanted to provide public comments to the hearing. And if you do, please press 0, and then you will be able to provide comments to us here in the room. In the meantime, I think Lisa Lana has signed up and would like to provide testimony. Is she in the room, Lisa Lana? Is there anybody else present in the room who wanted to provide public comments before? Please come up. Anybody else? We have 3 seats. And thanks very much for sitting through the hearing and coming up. So while we're waiting for Ms. Brown to press 0 and queue up, we'll go ahead and take our last two witnesses in the room. And when you're ready to get started, we'll go from my right to my left and introduce yourself. And thanks for coming.
Thank you, Commissioner Taylor. My name is Brett Copeland. I live in the Columbia Heights, Ward 1. I hadn't planned to testify tonight, so I hope that you will excuse me not shaving, but I do have my insurance card with me, and I really think that, for me, it's a symbol, kind of a culmination of why I came to Washington, D.C., in this great city. I've always wanted to live here, but I was able to move here without a job because I was covered under my parents' COBRA. And I think that's so key when we talk about insurance, is this power of mobility. And I slept on one of my friend's floors until I did get that job and got my own insurance. And as any good community member, you want to pass that kind of favor on. So my best friend moved here to DC as well, slept on my floor for 6 months until she could find a place to live and her own job. But it didn't come with health care. And in the summer of 2013, she was diagnosed with a very aggressive form of breast cancer. She's, at the time, was my age at the time, 26. And without insurance, she went from being diagnosed to having to fight with multiple healthcare companies to try and find insurance, which was unaffordable. Had a double mastectomy, and I was fundraising for her to try and help her pay those bills. So, knowing that, I would never go without insurance, even as a young person. I've seen the impact of what one illness can do, and for me, in this card here, I purchased the Platinum plan from Blue Cross Blue Shield because the deductibles were lower, even though my premiums are higher. But I am still paying quite a bit as an individual for those premiums, and it's at the edge there. I left my job earlier this year because I knew I could purchase my own insurance to start my own business. And this plan has protected me as I've traveled across the country to build my business for here. So I really appreciate this plan, but any type of increase, even just a little bit, and especially not the number that is given tonight for Blue Cross, is really tenable for me. So I appreciate your work in helping keep these costs down, and I would encourage you to really consider what mobility means for residents here in the District of Columbia, and what kind of community we want to be, because healthcare is a huge part of that. So thank you for your time.
Thank you very much. Really appreciate your testimony here, and that's very important. I'm glad you're here, and I'm glad you didn't have to shave, so you're fine. Please. Yep.
Hi, my name is Allison Borst, and I'd like to thank the DISB and the Commission for having us here this evening. You've heard from a lot of people tonight. Frankly, most of what I'm going to say is going to be a repeat. But CareFirst is my health insurance provider. I opted, like you did, for the more expensive platinum level plan because although I am fortunate enough to be healthy, my family has a history of most of the common problems. That's early onset heart disease, heart attack, stroke, and 3 different kinds of cancer, including, in fact, the anaplastic glioblastoma that Senator John McCain is suffering from right now. It is not an exaggeration to say that without health insurance, my family wouldn't be bankrupt. We'd be dead. So that's, of course, why I'm here tonight. My health care plan costs me $378 every month, and it's very expensive, but I pay it because I know just how important it is to be insured. CareFirst is proposing to increase the rates for individuals anywhere from 17.7 to 29.7%, and forgive me if I get those numbers wrong. I did my math when I thought it was in the 30s. I'm fortunate enough to be young and relatively healthy for now. I'll probably be on the lower end of the increase scale, but even with the bare minimum, I'm looking at new monthly rates in the 400, 450 range. Every year, things get more expensive. Rent goes up, utilities go up, Metro increases its fares. Wages are not following suit. You know, if you're lucky, maybe you get a cost of living increase of 25 cents an hour. That doesn't cover my Metro fares, let alone health premium increases. It's barely affordable at the rate that it is now. An increase of, quite frankly, an increase even at the suggested level of, I believe 16.4, it's unconscionable. I don't know who can afford that. So I'm urging you to do whatever is in your power to make these rate increases less. I know everything goes up, but putting it even in the double digits, you know, let alone what CareFirst is asking for, but even in the double digits at all, I just don't see how it's justifiable or reasonable. But residents such as myself need to be adequately insured. So I really thank you for your time and your attention this evening to this devastatingly important issue. Thank you.
Yeah, thank you for your testimony. It was really, really important to hear that. So I appreciate that. Thanks again for both of you coming. Is there anybody else in the room that would like to testify? And did we get Ms. Brown, or we didn't get Ms. Brown? So it sounds like nobody else wants to testify. If not, we'll go ahead and sort of moving towards closing the hearing. I really wanted to thank everyone who shared their valuable time with us today and provided important and often heart-wrenching testimony. It was really, really important for the public to hear really what the increase in rates really means, and really important that the health insurance industry, and again, we talked to a number of companies here, and we appreciate the work all our carriers do in the District of Columbia. It's important that we have a competitive market, and we appreciate the carriers here. Of course, as said, we work to make sure that the rates are as low as possible and justified, but again, we appreciate all the carriers. So it's important for the carriers to hear what the impact of these rates are, and as well as for me and my team to actually really hear the import and impact of our work in this area, and it's really important. So really, really appreciate everybody taking the time to come and talk to us. This will, again, make us go back and redouble and take into consideration of what folks testified about. And I really want to thank, Mila Kaufman and the DC Health Benefit Exchange Authority for its testimony, valuable input, comments, and recommendation. We're going to take that to heart as well. So, and lastly, as folks heard, this is our first time we did this. So when I told my team I wanted to do it, they said, what? And then, but they really got together. I really want to thank the team for doing it so quickly. And as I said, this is the first time, but it won't be the last time. Again, I really want to thank my team, Tanya, Brian, who's in charge of our communications department, and got to get everything together. And we have a second event going on at the same time tonight. So sometimes they play baseball, they do a doubleheader sequentially, but we're doing things simultaneously. So again, Tanya Bryant and her team really stretched in, but appreciate that. And again, Howard Levers, Adam Levi, Phil Barlow, and Dave Dillon, so really appreciate that. And if nobody else has anything else to say, we'll go ahead and adjourn the meeting. Again, thanks very much, and I really appreciate everybody's time tonight. Thank you.